Welcome, Mr. Kaskadan, and give us your remarks.
Hi, good morning. Dear hosts, colleagues, and partners, on behalf of the Insurance Payments Guarantee Fund of the Republic of Kazakhstan, I would like to express my sincere gratitude to the organizers of the conference for the invitation and the opportunity to address you today. It's a great honor for us to practical participate in the first Africa Insurance Resolution Conference 2025, dedicated to such an important and timely topic as strengthening the resilience of the insurance sector beyond failure resolution policy and practice. This is traditional Kazakh house. In Kazakh culture, there is a special symbol, the shanrak. The shanrak is the central element of the traditional yurt, through which all the main structural force pass, uniting the home into a single whole. Shanrak here. For the Kazakh people, the yurt has always symbolized resilience and stability under any conditions. In the same way, the Insurance Payments Guarantee Fund serves as a kind of shanrak, so the insurance market. They maintain the financial stability of the system, protect the interests of policyholder, and strengthen public confidence in insurance, ensuring resilience even during periods of the market turbulence. Today's conference provides a valuable opportunity for professional dialogue, the exchange of experience, and the discussion of the best practice in resolving insurance obligation across various jurisdictions. We firmly believe that cooperation and knowledge sharing are key to strengthening national insurance guarantee systems and enhancing financial sector resilience globally. This year, the Insurance Payments Guarantee Fund is also proud to host the International Conference and Annual General Meeting of IFIGS in Almaty, reflecting our commitment to strengthening international cooperation. We are confident that these joint efforts will contribute to building more reliable, sustainable, and trustworthy insurance system worldwide. I wish all participants fruitful discussion, effective collaboration, and practical results that will help make our insurance market stronger and more resilient for the future. Thank you for your attention. Thank you.
PCF Honorable Trustees, PCF CEO, IDIC, Chairman, CEO, invited guests and morning. I am delighted to be at today's Castle 20 years of PCF. I must say, where I see that we are very proud of the work that PCF is doing. When PCF was envisaged and began operations in 2005, we foresaw a situation where PCF would come in quite handy to support policyholders whose insurance companies, or where they had taken their policies, have gone under and they need to be compensated. I know most of you have risks myself, but of course, insurance, being a risk transfer mechanism, provides a lot of benefits, but albeit there are risks. I think you heard from Suma, or the managing trustee, that insurance companies do fail, and they fail every single day. You may remember that when those California fires and the homes that were burning in the US, so many companies went down. So many companies who could not pay claims or compensation to their policyholders because of those catastrophes that have happened in most parts of the world. And at that point, that is when you need a guarantee scheme that would come into your assistance. And I'm proud that PCF has come in quite handy. I know in the beginning there were a lot of challenges. We were not able to pay compensation until a company was amended, so once the manager is appointed by point 21, the first beginning into the commission went to have some companies at a point in time. That's very long to be decided in court, and some after 10, 15, 20 years, you are compensating people compensated in 2005, 2009, 2010, 10, 15 years later. And you can imagine the value at that point in time and now. I must say now, since that has been done away with, holders have pleased that they can be able to do their claims. It's paid by 20 days. And I know, I think this is something that is based off, is that the compensation amount of 250,000 may not be adequate. It's a place to begin, and I'm sure that there comes that amount we looked into you to increase and making it to get compensation that it may not be adequate, because I know most sum assureds are in excess of, there are millions of shillings, but the compensation of 250 is a big challenge to bridge that gap. But nonetheless, those issues would be addressed in the coming days. And I don't want to make too many statements. I think I will leave this to our chief guest, who is going to be Honorable Simon Bugwa, the chair of the board of PCF. And with those few remarks, I want to wish these delegates and all of us quite fruitful discussions for the next 2 days. And also, let's learn how we can be able to do our work better as PCF and as other guarantee schemes who have attended from the continent. I know currently we may only be 1 or 2 countries in Africa that have compensation schemes, but we look forward to everybody else coming on board this train in the coming days so that we can be able to take care of our policy holders. And I do tell many people and gatherings that that individual policy holder sums up to the total policy holders that we have in an economy. And everybody is trying to transfer their risks so that they are compensated when the time of need comes. So on my own behalf and on behalf of the board of IRA, I want to congratulate PCF and the delegates for attending this very important conference. Thank you very much and have fruitful discussions.
Thank you. Could you give him a more better clap? That is the Commissioner for Insurance, also board member of Police Officer. But without much ado, I would like to welcome our guest, who is also our chief guest now sitting in, Honorable Simon Bugwa, the chairperson of Police Holders Commission.
The board of give me one. That we are in this college
just that park is not just in Nairobi. That open door there, that is the national park. So I'm sure in your free time, when you go to the final deck, you will be able to see the animals, especially during tea break. Thank you.
Thank you very much. Good morning, everybody. My name is Liberia Sikuku. I'm a trustee representing the general public on PCF. I'll not make a remark also as my colleague has put it, but I just want to say one thing, that every opportunity is a learning opportunity. And I know, having gathered here with minds from different countries and different sectors in the guarantee schemes, we are going to learn a lot so that we are able to cater for our policy holders to increase that trust in investing in the insurance sector, and also to give them relief whenever there is a case where our insurance goes under. Otherwise, I also want to join my colleagues to welcome each and every one of us in Nairobi, enjoying the learning and enjoy all other things that will follow afterwards. Good morning.
Good morning. Good morning. You're well? My name is Janet Kongo. I represent the Honorable Attorney General at PCF. Mine is to welcome you all, and it's my desire, out of this session, we're going to take PCF to a better place, and we'll welcome you again, PCF at 25, to tell you, or you give us a feedback of where we are. Thank you very much.
Godfrey Kiptum, Commissioner of Insurance and the trustee at the PCF board. I think I've made my remarks, so I'll not add anything else, Chairman.
Thank you so much. We also have a colleague who also nearly works in this industry. Her name is, I spoke with Ali. And I'm a board of the trustees of PCF, and it is great today at this as we 20 years of policy holders compensation fund. Our theme is strengthening insurance sector resilience beyond failure. Thank you. So the insurance industry is vital to economic growth, boasting a total assets of about 1.06 trillion and contributing about 2.4 of our GDP. Insurance failures threaten policyholders, employees, and market confidence. Strengthening resolution frameworks is critical to closing this gap, encouraging investment in the insurance products and supporting sectors like agriculture and entrepreneurship. So I just want to explain a little bit about PCF, and most people, they don't know what we do. The insurance that you have, we take 0.5%. The car insurance that you have, we take 0.5%. The way Commissioner was explaining, so that in case the insurance company goes down, we cushion you. So that is the work we do as PCF. And since its inception in 2005, PCF has been a beacon of protection for policyholders in Kenya, established under the Insurance Act to compensate claimants of insolvent insurers. So before, PCF policyholders and claimants were left stranded. Initially, there was no institution like this. And mark you, this is a parastatal. So initially, when an insurance company used to go down, claimants were left stranded, lifetime savings lost, legal remedies inaccessible, public trust deeply eroded, with no recourse beyond lengthy judicial processes to resolve the insurer. So whenever a company went down initially, there was nobody, but now PCF is there to compensate. Though the amount is little, as the commissioner said, we are working on the figures to raise them up as contributions increase. So today our asset base is 5.7 billion, which is equal to about 200 million. And our cap is about 250,000, about $2,000. But we are raising that, as I said. So per claim, we are dedicated to financial stability. Our role extends beyond risk monitoring. We also do statutory management of we do policy advocacy and a quest to align guarantees scheme IGS principles. So we follow the IGS. Forum of Insurance Schemes is a pioneer as representation. So we are one of a kind. I think in Africa, one of insurance guaranteed scheme. So we have a place, we have in place a robust operational framework and regular tested compensation framework. Since commencing compensation for claimants of insurance in 2021 and recent failures, we've demonstrated that effectiveness mitigates the impact of and economic resilience. Through our inaugural compensation exercise in 2021 and our participation in the Joint Financial Sector Review Forum, we've turned policy into practice and strategy into public value. As we enter our third decade, our strategy is ambitious and deliberate. We are committed to strengthening our legal and institutional framework to allow more proactive engagement in resolution planning. We have commenced deliberate and focused work in developing a robust legislative framework to enhance compensation of policyholders and prompt resolution of insurance. The draft PCF bill, which we have a draft bill, which we are working on currently. It is still in the development stage, and insights from this forum will also be invaluable. So if you have anything to add, anything to contribute to our bill, your insights are welcome. So PCF's role, what we are doing, we are enhancing visibility and stakeholder awareness. As I said earlier, most of the people don't know even our organization exists. So we are working hard to make sure that our organization, which is professionally, 100% professionally run, is visible. So we are deepening also partnerships with financial sector regulators to jointly minimize risks and losses across our ecosystem. We are also doing advocacy in policy to ensure that compensation levels and funding models remain effective, sustainable, and aligned with evolving industry needs. You will notice that the industry is greatly changing and needs also new needs coming up because of technological changes. So we are exploring also new frontiers in digital transformation and are studying models that integrate early intervention and loss minimization, moving to a risk minimized model of IGS. So this conference is an opportunity to exchange resolution, reduce cost of area, challenge gets to explore how IGS can innovate, drawing inspiration from experienced counterparts within France and banking sectors. Together, that financial inclusion and investment, ensuring a sustainable and resilient insurance sector. I'm proud of PCF's journey and hosting this historic event. Let us to build insurance that not only recover from failure, but it foster confidence in Africa. My brothers and sisters who are present here today, our work is not just started. Global landscape is shifting. Market risks are complex. Expectation of memory and the support of partners like you, I'm confident PCF will continue to lead boldly, competently, and with courage. Thank you very much, participants, for being part of this journey. I really, really appreciate you for taking your time to attend to this conference. Karibuni Nairobi, and you've been told that door leads to the national park. So don't leave before you go to the national park, for those who have come from out of the country. So Karibuni Nairobi, Karibuni is welcome, Karibuni Nairobi, and enjoy. Thank you very much. So I was bestowed the cup of being the chief guest, which is, those are big shoes, but nevertheless I'm up to the task. So before you take over, I'd like also to introduce the members of staff for PCF. Wherever you are, just stand. So, and wave. Those are our members of staff. Wave. I think Abudo, will you introduce them, or we introduce along the way? Okay. Thank you very much. Take a seat. Thank you so much. God bless you all. Asante. So they're telling me, since I'm the one to actually the conference. So I take that responsibility. The conference is officially open.
Thank you very much. All speakers who've been able to grace this wonderful stage, these gentlemen. Earlier on, I indicated we have come to do 4 things. We were demonstrating them in style for our guest in Biden. We are going to repeat this. We are in this conference to do 4 amazing things. First thing, we are here to enjoy. For all who had not been, when I said the word enjoy, was supposed to clap. So enjoy. We have also come here to with like-minded people. When I connect, you are to snap. So connect. Very good. So enjoy. We were also saying that we have come to works of friendship, and when I say the word network, high-fiving your neighbor. So network, you high-five your neighbor. Very good. Finally, we are here to celebrate PCF at 20, and when I say the word celebrate, 1, 2, 3. Celebrate. The first one is enjoy, connect, network, celebrate. Very good. We are good now. So I'm going to give you our beautiful story in very short terms, and if I mention those words, please act appropriately. I've noticed the camera crew is very keen, so give us a big smile while at it. Okay, let's try. We are enjoying a beautiful scenery at the edge as we connect with people and form great networks just next to the national park. So remember to celebrate, and while you celebrate, always enjoy every moment. Now you can learn to connect with each person you're seated with and network with them. As we do so, remember to celebrate every opportunity that you get to enjoy. But remember to connect with people's hearts, give a good network around here, and of course, celebrate each moment. So remember to celebrate. Every speaker who's here has been celebrated, and for every speech we received, we celebrate. Now that was clapping in style. Now, we are going to have a wonderful time to enjoy a documentary. This documentary is highlighting the journey. As I told you earlier, 20 years, if you had a child who is 20 years, that is an equivalent to university student who is already aligned the dreams and ambitions and delivering on his goals in the journey of success. So PCF is technically a university student focused in delivering very much excellence as per the dreams and ambitions of the founders. So as we turn our attention to the screens, we will be able to see this beautiful journey so far, and then we will celebrate the moment as it deserves. Please turn your attention to the screens and enjoy the documentary.
In a world where risk is a constant, insurance is the promise of protection. But what happens when the promise breaks? 20 years ago, a bold idea was born to protect the protected and restore trust in an industry shaken by uncertainty.
Failure.
The last 20 years have been marked by milestones, opportunities, but PCF resolve remained to timely compensation, disabled, and prompt deletion of insurance.
One of our major challenges is limited public awareness and understanding of PCF PCF role. We overcome deliberate stakeholders engagement with outreach program consistent. Another challenge was also developing interacy, which we addressed through rigorous staff training.
But what PCF compensation process?
What triggers compensation is the decision by your commissioner of IRA, Insurance Regulatory Authority, or play the statutory measure.
Compensation PCF claimants take a period of 90 working days from the date of receiving fully filed forms.
Since 2005, when the fund was started, 7 companies have gone down, 4 currently compensating, the other 3 completely has lapsed. The 4 currently is Evolution Insurance Company, Limited Insurance Company, Insurance Explico.
Kupitia wakili wangu ni accident nilipata, nikagua aina ya Probox. Mimi na watoto wawili, ilikuwa ni Nakuru, place inaitwa Umoja tu. Nikapelekwa matibabu Nakuru Hospital, na tulikuwa na injury ya mguu. Mimi nilipata injury, nikavunjika mguu. Nikaenda pale, nika apply, kaambiwa ningoje 90 days. Nikalipwa shilingi 1250.
The fund covers claims arising from all insurance policies issued in Kenya. However, the following exceptions hold. 1. A policy of reinsurance. 2. A superannuation scheme. And 3. Claims arising from policies issued before the fund commenced its operations. Since its inception, PCF has compensated claimants of 7 collapsed insurance companies. 3 companies that PCF has finished compensating during the 2-year period are Concord Insurance, Standard Assurance, and Resolution Insurance. As the world changed, so did the fund, embracing technology, refining governance, and expanding public education to ensure every policyholder knew their rights. The Policyholders Compensation Fund remains a pillar of financial stability. Its goal endures: to safeguard, to reassure, and to build a future where trust is never in doubt.
We had an incident. We insured with Blue Shield Insurance Company in a previous form, which was existing at Keast, and one fine day we had a sudden heavy windstorm, and a lot of damages to my greenhouses happened. Some of the greenhouses the plastic blew away, and we had severe damage to an extent of 3.3 million something worked out. And since it was under Blue Shield Insurance Company, we lost our claim to Blue Shield. Unfortunately, Blue Shield, while processing, went down. I think we got lost. So we have been issued some lists, and later on fine morning, PCF called us quite about this particular claim. Yes, we confirmed them. Yes, but Blue Shield has not settled that one. PCF of a brief period verification of things. The amount for the discharge, whatever we are, they have paid to us, and it went directly to our account.
Husika kwenye accident 20 na ile gari ilikuwa imenigonga, ilikuwa under Explico Insurance Company. Kwa hiyo insurance company kwa wakili wangu nielezea kuwa kuna policy compensation fund ambayo inaweza nisaidia jaza form alafu nikaweza kusaidika.
As the fund marks its 20th anniversary, holders look back with satisfaction.
During my tenure, one of the things that we did police holders compensation of the PCF, a guarantee scheme, guarantee police holders and officials in the event of a failure of any company. So in the year 2004, sort of failure of a number of insurance companies, particularly with vehicle underwriters, it was deemed then necessary that we would need to establish this fund. It was the first of its kind in Africa, and therefore we had very limited areas to learn from in terms of operationalizing that section of the Act.
The vision for PCF is a compensation of policyholders for companies which have been put under statutory management or where a license has been withdrawn. The response for the setting up of the PCF was because of certain insurance companies which had failed, and we needed a cushion for policyholders so that they have a fallback in case a company goes bust. And PCF was set up for that. And the whole idea is to have that confidence, for policyholders to have that assurance, and also to make sure that we have confidence in the industry. The reason is that if we have confidence in the industry, we can contribute to the growth of that industry. And generally that will support even other businesses in the country. Thank you.
Enjoy the current and look forward with optimism and renewed strength.
As an authority, we ensured, so we started off with the operationalization of the fund in 2005, and which entailed putting in place basic operational structures to facilitate the fund's day-to-day operations. That entailed making sure that we had a space, premises to work in, and to engage with our various holders. The fund, for all intents, is operated as a steady, and therefore needed to comply with various requirements, of which we did diligence for a time period.
Accordingly, the biggest challenge we actually faced, I believe, was we earmarked almost $1 billion to pay compensation to people from collapsed. There were 4 companies that collapsed. During that period, budgeted and made money available for compensation. We were held back by the law. At that time, it was not very restricted. That companies that had to be wound up before we pay any compensation.
SPC marks 20 years of service, pride and encouragement. PCF has come a long way, but its mission is vital. I urge leadership and staff to maintain status in holding the fund's values and to constantly innovate. Deepen collaboration with stakeholders. PCF's next 20 years be impactful, guiding policyholders and resilience of Kenya's insurance.
Wonderful, wonderful, wonderful. Wow. Wow. I'm sure the founding fathers of this dream are proud of how far we've come. It's beautiful. And I hope you've enjoyed the documentary, including the end whereby we see the team building. It shows you that we are not just about work. There's also the part of the play just to ensure that our staff are re-energized and revamped to deliver the very best. So once again, thank you very much. At this moment, we want to have some taste of goodness. They say in the African culture, it is important that every celebration is capped with the breaking of bread. But bread in this case will be a quality cake prepared with finesse. And it was actually prepared by a chef who deliberately had to do it with a taste of 20 years of excellence. They say the good wine is the one that ages with age, but the cake was prepared with the age in mind, so that it gives you the very best at the Edge Convention Center. Now that is me trying to be poetic. Now, at this juncture, we're going to have a cake cutting ceremony, and then after the cake cutting ceremony, I confirm that this cake will be served together with the breakfast or the tea break there. So we will ensure that everybody has a piece of the cake and enjoys it to perfection. So to help us in this category, I wish to invite the board members to come over. The board members, please come over for this beautiful session. And also our guest all the way from Kazakhstan, please come over and enjoy Kenyan cake. It's next to the national flag. I have been sit on that one too. Please welcome our board members. Please come over. Right, and of course the board members and of course please come over to join us. So we're going to face in. Just come. Rosemary will on how she and you come over. Holding cake. It is written celebrating 20 years of Dhamana Yabi. That translated to Holders Fund selection for 20 years. Step off the photo. Most of our Kenyan celebration, there is usually some accompanying music that comes with the cake cutting. We are good with it. So, Rosemary, who takes the knife as the symbol? So, chair, please hold off nicely. Family, our from Kazakhstan, please proceed to hold the pass. Now, this is the collaboration that we are looking at. Now, please, in a way that we are the excellence 20-year, I'm sure up nicely to ensure that we end up just confirm. Okay, proceed to cut. The others can mimic stretch your hands. Yes. The cake is big enough to accommodate us all. As we celebrate 20 years, a big round of applause as we celebrate 20 years of PCF. We celebrate you, we celebrate you. And we are honored that you've been able to join us on this noble occasion. And we celebrate you so very much. And we are happy that you've been able to join us here on this celebration. Policyholders Compensation Fund at 20. Well done, well done, well done, well done. If you see the, yes, I'm sure. Awesome. Thank you, DJ. Now, with that, and we will be having, yes, the cake is, Bwana Chair, you are very good in dividing the cake. This is really good. We are so honored. It shows that our national cake is going all the way to Mashinani, right? And ensuring that everybody is well compensated in the unfortunate event that an insurance company goes down. So thank you so much, Policyholders Compensation Fund, for inviting us over for cake. So as you get to enjoy, the rest of us will enjoy visibly for the moment, and then confirm that this cake will now be served at our tea point to be able to ensure that everyone gets it. So proceeding first to feed our guest all the way from Kazakhstan, please enjoy the Kenyan sweetness. He says you have to finish it. Okay. Yeah, we celebrate and have a good time. Thank you. Very well. Thank you. Thank you. Yes, the chair is ensuring that he delivers it. Somebody is on a diet specifically, wanted it as small as possible, but chair insists that in Kenya we don't serve it small. We serve it in big quantities. That is how the MC got to where he is now. All right. We will ensure that the cake reaches all of you nicely as we celebrate 20 years of excellence. Thank you very much. We appreciate it. Thank you. And okay, Dr. John has bigger because they say to whom much is given and much expected. Thank you so much. Thank you. And yes, thank you. Thank you. Thank you. Yes, and as I tell you, this song is just into my vibes because from 6 tomorrow we'll be at the carnival. Yes, and the African theme. Just get best African attire because we're a carnival to enjoy what peace for us. Tomorrow in the evening from 6 p.m. You should be ready for it. We'll also be generating to the rhythm of music in the best way possible. All right, the photo team has requested me that it has cake first. Please make your way again for another photo, and we will organize to have photo a bit later for the delegates, speakers who have been able to join us. Welcome to photo at the podium as we have a memory of the same. They say, Bwana Noel, by you should joining on this one. The people on the red seats, born ready. Yes, you can have it like what? Yes. Welcome for the photo. All right. All right, ladies and gentlemen, as we do the photo, we want to confirm our program is still running as indicated. We are going to take our break, which should be around 30 minutes to ensure that you quench your thirst, refresh enough for business of the conference, which has just been declared open. All right. So that we can get ready for our tea break, we can get set to do it in a short while once the team confirms that the best photos have been received. The media team for the newspapers. Tomorrow's front page will be PCF at 20, I hope, and then on the footer will be a photo of me showing my mathematics teacher how far I have come. Yes. Awesome. I will be asking hapa ni wapi. All right, now for all the guests in the room, please be upstanding because I want us to stretch and then we can head for our tea.
And we have been doing desktop exercises to see what it would look like when it eventually happens. What do we cover? We cover most things that you buy when you buy insurance. We certainly cover all of the basics that retail consumers buy. We protect car insurance, we protect home insurance, we protect small business and SME. But we don't cover everything. There are exclusions, and they are, as you will see, mostly specialty lines: aviation, marine, surety, fidelity, directors and officers. So you can see that the design of our model is very much focused on protecting retail consumers, and sophisticated buyers, normally taking the advice of sophisticated intermediaries, are on the hook if they choose to transfer their risk to some weak insurer with a weak balance sheet to get a saving on price, that kind of serves them right. I guess that's the thought process behind our design. When a company fails, there are 2 or maybe 3 types of claim. So first of all, people pay their premiums, and there's unearned premium. There's a portion of the policy that has not yet been earned when the company fails. On average, that'll be 6 months of policies, though this number is changing as more and more consumers purchase and pay monthly on their credit cards or through direct withdrawal from their bank accounts. But if you think about what happens in a bankruptcy, the liquidator takes over, sends a letter to every policyholder, says, your company's gone under. Sorry about that. You have 45 days to find replacement cover. If you have an outstanding claim, you're protected. If you have a claim in the next 45 days, you're protected. After that, you're out of luck, so you better have found replacement cover. And the number of policyholders who freak out when they get that letter is roughly 100%. And that's a reputational risk for the industry and a potential negative impact on confidence. And so we have found in our history that it is super valuable to rapidly refund small checks to as many of the policyholders as possible. So if we can refund unearned premium, we can reduce the stress level in the system to the 2 or 3% of policyholders who have an actual claim at any one time. And so the industry has discovered over time that refunding unearned premium has a very healthy, positive impact on the overall stress of the system when a failure happens. The second sort of claim is people who've had a claim and it's already on the books, they're in the process of negotiating the final settlement, and their company goes under. That's serious. Those people being able to respond promptly is a critical point. And then finally, this has not yet happened in Canada, but we are quite sure someday it will. You're going to have a catastrophe. Climate changes, events that are outside the model and increase the risk that some company is going to fail because it misestimated its exposure and had an excess of aggregated risk in a particularly adverse area impacted by wildfire or hail or flood or earthquake, which are the primary perils that we focus on in Canada. So in that kind of scenario, there would be a lot of new claims coming in. We've never had this experience yet, but a lot of our planning is about how we would handle that wave of additional claims separate from outstanding unpaid claims on the books of the failed insurer when it happens. The other point that's important to make here is that property and casualty tends to be settled differently than life insurance. There's a big difference in how you handle a short-term contract and a long-term contract. And so in a short-term contract, you can send the letter that says 45 days, find a new car insurance company. And people can find a new car insurance company. But you can't send that same letter to somebody who bought a 20-year term life insurance policy. And since they bought the policy, they've had a heart attack or a stroke and they're now uninsurable. They have no ability to replace the policy. And as a result, you need to have solutions for continuation. You need to find a buyer for those liabilities. And so in Canada, we actually have 2 very different compensation funds, one for P&C and one for life, precisely because the solutions tend to be completely different as to how they're managed. This isn't always the case. We have examples in IFIGs of countries where it's all done in one organization. But in Canada, we have found that it makes the most sense to split. Now, I was very interested in hearing that you were in the process of reviewing your coverage limits. You had, I think, said 250,000 shillings currently. So just to do the Kenya arithmetic, it's 1 shilling equals 1 Canadian cent. So you just add 2 zeros. So you're paying 2,500 Canadian dollars is your upper limit. So PASIC in Canada does not pay 100%. We have a coverage limit as well. And so our current limits are 520,000. So that would be 52 million shillings. I think just roughly doing the arithmetic this morning. So we cover a little bit less for car, and we cover a little bit less than that for commercial. This again amplifies that we are primarily designed to protect retail consumers. We are not a business protection mechanism. Businesses, big businesses, are assumed to know what they're doing, and if they buy from a weak insurer, that's supposed to be more their problem. And obviously the biggest insurers have big policies with multiple subscribing insurers on them. When I was CEO of Zurich, I did a lot of that stuff. And obviously, if one company on the subscription fails, that's not the same threat as if your car insurer fails and you've had an accident. And then we, as I mentioned before, refund unearned premium. Now, starting last year, our board decided that we would add inflation to our limits and adjust them every year. So as you're thinking about possible solutions in Kenya, we have the consumer price index, and so for 2024 it was 2.4%. So effective July 1 of this year, our limits will go up from the 520 to, we have a rounding policy, 525. Our limits for car will go to 420, and over time we just hope that the limits are steady and constant, and people do not have to worry about the erosion of benefits because of inflation. So that may be of interest to you, but a starting question that you were asking is, how do I feel about 250,000 shillings? Is that a good number? So what we did in Canada was go to the entire insurance industry and do a data call and said, give us all your unpaid claims. And we got 750,000 data points in a third-party actuarial consultant on a separate secure portal. I never saw any one company's files, and every data point was fully anonymized, so there was no personal data attached. But what we were able to do is find out what the average claim is for home insurance. What's the average claim for car insurance? What's the average claim for commercial property and for commercial liability? And so our limits at 520,000 I mentioned covers roughly 98.9% of all home insurance claims. It's a pretty good limit. That's a pretty good level of protection. Now clearly, the 1.1% that are not fully covered, they will get our compensation up to our limits, but it will not be enough. And we do have the research to show that the people who have the claims above our limit have big claims. And so as a percentage of value, our limits are not as good. But if you want to look at a system and say, how do I feel about 97 or 98% fully covered in terms of maintaining confidence and in terms of protecting the system's reputation overall, we feel that those limits are very good. And now that they're protected by the inflator, they no longer are subject to inflation threat either. So we feel decent about our protection that we offer, and our regulatory partners have accepted that this is an acceptable limit. They're not pushing us to go to 100% of policy or anything like that. Now, how do we pay when this happens? So we, again, I mentioned, we do not charge for PASIC's coverage on the policies. So the technical way of describing it has got some Latin attached. So there are ex ante funds and there are ex post funds. Ex ante is where money is raised in advance. That would be PCF. You're charging a percentage of each policy, you're putting it in the bank, and you are preparing for the next insolvency. We, in PASIC, are ex post. I have a little bit of money in the bank. I have short-term borrowing capacity. But if I need more, I go to the industry and I give them a bill, and they have to pay. So what is our short-term model? I send out a little bill every year to every company, and that pays my salary and my little team and our expenses. So, trivial. 12,000 a year. Let's see, add 2 zeros to that, and you've got shillings. So it's not expensive for any insurer to be a member of PASIC, which they have to be by law. But I do not send them an expensive bill. I have 63 or 64 million dollars in the bank. That means that in that first month, when I want to refund unearned premium, I have some cash available to start mailing checks fast. I have a line of credit with 6 Canadian banks. I pay a standby fee to the banks, but I can have another $250 million. So add 2 zeros and you get shillings, so that's quite a lot. We estimate that that would allow us to fund all unearned premium refunds and all claims for at least 6 months for the average company in my membership. I have 164 insurance companies that are members of PASIC. My average company, if they failed, the first 6 months I could manage just with the short-term capacity here before I have to send a bill. But once I know how bad it is, I have to go and get all this money. And the deal is a simple one. I pay the policyholder their compensation. The policyholder assigns their claim against the estate to me. So I'm a timing of money solution. I quickly look after the policyholder, and then I get in line, and when the court finally settles the estate 15 or 20 years later, I am the largest creditor, and I normally get some money back, on average about 60 cents on the dollar, and then I refund it to the industry. But in the meantime, I send out an assessment for whatever I need, and that assessment is paid by market share by every other PASIC member insurer in Canada. No choice, no option. They have to pay, or they are disqualified from their license in 10 provinces and 3 territories of Canada. I have never had an insurance company not pay my bill when I send it. And I could send a very big bill. I can bill for up to 1.5% of the direct written premium of every company each calendar year for as many years as I need. So right now I have the ability to send an invoice for 1.3 billion. So that would be 130 billion shillings. And I can send that invoice, and it must be paid within 30 to 60 days. So I have a tremendous amount of capacity in a crisis to manage. I thankfully have never had to send out a bill that big. And one of the things we model is what would happen to the solvency of the rest of the industry when I send out that invoice. And so I know today that I could send out that invoice 2 years in a row, bang, bang, and it would not cause any other member of PASIC to become technically insolvent. So there's enough resilience in the system that Canada has chosen to run an ex post funding model instead of charging each policyholder ex ante as you do. But both models work. And sometimes when I see ex ante funds, I'm kind of jealous, because it's super handy to have the money in advance. There's no doubt about that. Last part I wanted to cover quickly about our model is that we have these resolution powers. Again, we've never had them tested, but we have been doing lots of desktop exercises with the regulators, because we now have 15 companies in Canada that are so big that if they were to fail, my assessment more than the 2 years. And so I can't set out my goal. There's got to be a better option than find a buyer, break the company up and find buyers for different parts of it. Spin part of the company, the troubled part, into a bridge insurance company. I have a charter for such a company about to be approved. It will just go in a drawer in my desk. But there are all kinds of options to think about where I partner with the regulatory authority to engage in resolution activities, not just in liquidation and compensation. Now, why is this so great? Why has there been no Canada since 2003? There's a lot of different reasons, I think. Mandatory discounting of reserves, weighted solvency tests, annual regulatory filings required in Canada show you have enough capital and insurance to take your maximum loss, including a 1 in 500 year. Peer review of actuarial estimates, the own risk solvency assessment reporting, all of these grades in the rigor that Prudential Super to the insurance stress, significant stress. Possible application of standard actuarial practice much more sophisticated and rigorous. There's way better things out and management than there used to be. Certainly, the upgrade from the 38 years ago when I joined the industry to today. So many good stress that are applied. Much more sophisticated aggregation. They're educated. Insurance training. I got training after I got to run a company. Smarter regulators, not just smarter management, and the regulators with much requirements than they used to. This is all building contingency buffers. And in Canada, I would say that also is past there are almost 500 companies. Now there's 100 just withdrew from the market or got acquired or run off. And so today, remaining companies are much more robust, managed, better supervised, better capitalized, with much more sophisticated thinking about risk management. So that is a précis of the Canadian model. And I wanted to spend extra time on it because it is different from the PCF model. And we'll discuss later today when I do the IFIGS presentation. There are lots of different models for how you do it. Any of them is better than having no model at all. And so our diverse membership in IFIGS has many different ways to solve this same problem. All of them are better than not having a solution. So let's talk about my second topic. I think most are still okay for time here. So here I am at PASIC. I've got a team, I have money in the bank, I have a huge capacity, I have an active and engaged board, and the phone is not ringing. I have no bankruptcies to manage, so what do I do with the day? The things we do, obviously, is in a time of peace or war. So we do a lot of desktop exercises, regulators, and we're always kind of testing the stress level of the system to see what could cause a problem that's so big that our model would. But one of the other things we do is research, and we have published research on why each of the Canadian companies that has failed. What did they do wrong? What were the early years? What were the red flags? What could the regulators have spotted in advance? But we out of in failure, and so we started thinking maybe we could learn more from failures. And out of that research has been our whole catalog of insurers. course, it turned out to be super hard to find. Why? Because when companies fail, it's embarrassing to that country. It's embarrassing to the regulators. It's embarrassing to the industry. And so people do prominently failures on their websites. People do not have stuff completely. It has turned out to be very challenging to find evidence of insurer failure. So we've been Googling and GPT and networking with folks around the world to try and build out a catalog. What's the definition? It's when you exit the market involuntarily. If you decide to just give up, I'm no good at insurance, this is really, I'm going to stop writing new policies, I'm going to pay off my old policies, and I'm going to return any capital that's left to my investors, I'm out. That's a voluntary exit. An involuntary exit. Prudential supervisor says, you are no good at this. You are in over your head. There's a hole in your balance sheet. I'm suspending your license right to business, and I am seizing control of what's attached to your right on, putting your person into account. That's voluntary. So we use that kind of a definition, and we've done our very best with Google Translate and all the other tools we've had to use to try and find the court records or the news stories or whatever of insurance company failures around the world. We had to find proof. We found lots of companies that stopped writing, but we couldn't find proof that they had exited involuntarily. They're not in our catalog. But the last part of our what's in the filter, we did our best to include all P&C companies, all life companies, all composite companies, i.e. companies that write both P&C and life, and reinsurers. So I just want to put this caveat, this is from my research team. They are not sure they're right about any of it. They've done their very best to translate, they've done their very best to search, but there are companies on the list by mistake. And there could also be we haven't heard about yet. And between our first edition and our second edition, we had some big adjustments. We found all these companies that failed in Spain. Turns out about a third of them were involuntary, but the others were voluntary, so we had to adjust in the second edition of our catalog. But there's lots of companies that we keep finding that we did not know about before. Anybody who looks at our list and says, hey, I know my country better than you know, and you're not right. I don't have 7 failures, I have 17. Or I don't have 7 failures, I have 2. Either of those, we would be happy to learn. So please let us know if you disagree with any element of our catalog. And on our website, we publish every name of every company, every country, and the year where we believe they involuntarily exited. And you can go and check for your country and make sure that the classic catalog is accurate. So what have we found? Since 2000, we have now found 683 failed insurers in 69 jurisdictions around the world. Really important point here. Companies fail everywhere. They fail in developing economies and they fail in developed economies. Insurance is difficult. People make mistakes, get it wrong, blow up their balance sheets, and they do it in most sophisticated economies on earth, and they do it in the ones that are just working out how to get an insurance industry going. Insurance is hard. Companies fail everywhere. We put in red on this slide where we have found failures. It is a diverse list. As you see, because there's failures everywhere. I can assure you that shows up versus America, which has failures all the time. And so nobody should feel embarrassed or ashamed to be on this list. Canada's list. Super interesting. So let's show you some time series. So 2000, and those of you who were around in the industry around 9/11 know a lot happened in the world. The dot-com bursting, the terrorist attack in New York, and a dramatic shift in equity market, and a huge shift in risk. Companies tumbled. And then through the financial crisis, there was very little spike. 06, 08, 09. But by then, there was the imposition of much more rigorous capital expectations. And the regulators really started putting a firm handle, first on the banking system and then on the insurance sector. So things have stabilized. But I want to make a critical point here. I go to meetings with IAIS. IAIS still does not have insurance guarantee mechanisms as an established part of the country. The argument here all the time is, well, now with Solvency II, there will be no more failure. There's still plenty of failure. And it has not fundamentally shifted since. There's a steady drumbeat of them every year. So the blue in each bar is property casualty companies. The red is life. The green is reinsurers, and the yellow is composite. So the answer is there's a nice blend. And in some years there's more life than there is in other years. And some years there's more P&C than there's others. Composite insurance isn't as common. Thankfully, reinsurers fail all the time. But there is a blend. Here's property casualty over the time period. And you can see that it has volatility in it. But I would also say it's pretty steady. Life insurance seems to be more cyclical, almost certainly because it's attached often to the interest rate movements that impact on solvency tests for long-term assets and long-term liabilities. And folks can just get on the wrong side of that. On average, about 7 life insurers fail every year over this period. Here's a composite insurance. As I mentioned, there's 2 on the planet. But in a way, there'd be diversity of risk by writing both P&C. But my suspicion is that sometimes one are bad at both. But it's also possible that one that bind program common and they're to cyclical reinsurance that can take primary. Just lots. It's better. Steady. Perhaps the most nerve-wracking of this is the fact that climate change on property casualty is just getting started. And so these numbers are able to make the number of insurers in the United States that have been brought down in 2022, 23 from hurricane events is far higher than it used to be. And I'll mention this afternoon, but there's a company that failed because of a single wildfire. That's 128 company. Anyway, I don't want to blow how much fun the story is to absorb, but here's just fresh research that's not in our 2024 catalog, but will be 25 edition released this fall. This is Africa update. My research team started doing more research in Africa when they knew I was coming to speak at the conference. Many of these failures were found in the course of the last few months in preparation for this conference. I was really hoping Nigeria would be represented here today. My team really wants to talk to them. But there's different cycles and different experiences in different jurisdictions. There was one that I noted, Guyana just has one failure. It's not their fault. It's a CLICO. It was a Caribbean-based multinational. It failed at the home office. And mismanagement. We had a so that even got it. They're exposed. They aren't of their. And of course, Kenya, you're there. Thank goodness there's people, right? So, findings of research here I wanted to share. I'm happy to try and answer a question you've research. And so, defined by that, we picked in a year period. And so you see in jurisdiction where we failure, there was at once. So as a supervisory regime, or as folks over managing competence in the financial services, that when they get one, you get to think calmly as you're doing. Normally, more than one, and it's probably a common cause. There's long periods of calm between failures in jurisdictions. So you can start to think you've got this looked after. You can start to think you're never going to have a failure and you don't need PCF in your jurisdiction. And then, bang. So here are the clusters that we have been able to identify worldwide. And again, we have put the African jurisdiction in red just to make it easier for this audience to spot. Angola, 5 failures between 2021 and 2024. I don't know what happened. My research team would know more. That's 5 to manage all at once, almost certainly a common cause. 4 failures in Ghana between 2015 and 2018. Nigeria has had clusters 3 times. 13 failures in 04 alone. 7 failures in 08. 8 failures between 2020 and 2024. So when it happens, it's awful. And we're all aware of just how difficult it is to manage the windup of a single insolvency. What this research is saying is when the challenge comes to a prudential supervisory regime and when the challenge comes to an insurance guarantee scheme in that jurisdiction, you are almost certainly going to be tested multiply. Have you thought about your stress capacity for that kind of scenario? Here's more of those clusters, and you can see America just does this all day long, state by state. And again, our American database is not as rich as it should be. Many states don't like to talk about it. There is no national database of insurer failure in America. So we're going state by state and trying to learn more about the cases that have happened. But on this page, I think Zimbabwe shows up. 8 failures in 08. Don't know the story. 12 failures between 2013 and 2016. That's just exhausting to think about being the guarantee mechanism in a scenario like that. And real challenges about what's the confidence going to be in the industry. And we all know that development and economic progress requires a successful insurance market. And so having resiliency and capacity in the system to handle and protect policyholders against clusters of failure, I believe is kind of one of the central elements here. And then the last thing here is, when you think you're good, you're probably just lucky. Here's the jurisdictions that had 7 or more years between failures and then had failures again. And our more African jurisdictions here, Canada is here. Our life guys had one in 2012. We thought we were amazing, and then suddenly not so much, and back to work. So final thoughts out of this research. There's no excuse to have a jurisdiction that does not have policyholder protection. And Kenya's leadership in Africa is inspiring, and I commend your country for doing the right thing, and I very much hope that the other jurisdictions attending here today go home with a message, and I hope that that message spreads. Economics is a tough thing to work out, but confidence and trust in the system is essential for progress, and policyholder protection is part of how you ensure trust and confidence continues. And then the final point, if you think you're good, you're just lucky. Failures will happen again. Insurance is harder than any other financial service. You're making a promise, and you're supposed to make it now and honor it later. You charge a price now, and you've got the most sophisticated actuarial guessing in the world. But all you've got is a guess as to what the actual price is going to be when you eventually settle those claims in the future, and how many there will be. Insurance is super hard. So failure will and will continue to happen. And when it does, policyholder protection should be there. So thank you for your patience with my little lecture at the end there. I'm happy to answer any questions you've got, or you can just tell me to shut up and sit down, whatever you want.
Wow. Let's give him a big round of applause for that wonderful presentation. All the way from Canada, we appreciate those great insights. I want to see if we have questions in the audience. I want to see the hands, and then I can. We have one. Any other question or comments? 2, 3. We will take the 3, and we will be, or there is a 4th one there. Okay. Very first, would you want to handle them after their question, or we do the whole bit and then you answer?
I'm an old man, my memory's not good enough.
Okay, so
let's do it one at a time. Yeah.
Thank you very much. I think for me, questions are very high level. Question is, you said insurance 500 to 164, so that's a 70% drop. Maybe give us more lights. Were there failures in that change, or this mergers and acquisitions, and or what really happened? In your opinion, what is the concept of recovery? Because you're saying that you recover your money after the collapse. You only have a few budgetary allocations for admin. Do you see that as a better model than this other one where you collect the money? Because if you have a big claim or you have a catastrophe, main insurers, then is there potential exposure to that model?
Great questions. So with regard to 5 down to 164, 13 were failures. The vast majority were mergers and acquisitions. We've had a rapidly consolidating industry. The requirements for technology, the regulatory expectations around enterprise risk management, small companies just were finding the burden too great, correctly. And so the last is that we had quite a large number of European insurers that chose to allocate capital to other jurisdictions that did not have such high capital requirements as Canada. So we had quite a big withdrawal of international. When I joined the industry in Canada almost 40 years ago, 2/3 of the market was foreign insurers and 1/3 was domestic. Now it's almost 70% domestic. So a lot of the foreigners left, the capital requirements got stricter and stricter, and they could allocate their capital in Asia or wherever and maybe make a better return. And as a result, we now have a much more consolidated, concentrated, and stable and well-capitalized Canadian market. But our premiums are very high. There's a price to prudence. There's a price for having that high capital. And so that is part of why, to try and connect to your next question, why we don't charge our policies. That's why in Canada we've concluded that ex-post funding will work fine, and we do not need to add further charges to the insurers, to the insured, because they're already paying a high premium because of all the capital buffer that each of our industry members has. And then with regard to recoveries, the recoveries are unpredictable. The range in our 13 failures is 0 money to 100%. In one case, it was a solvent liquidation. It just took 18 years to find that out. On average, it's about 60% of the money that we get back, but our courts take 15 to 20 years. So the time value of that money is much less. And so paying the policyholders immediately and then recovering for the industry. I just got a check for $100,000 on the 2003 failure that I will now refund to my members. It's hardly worth it. It'll cost me as much in postage and courier to do it. But you can't predict how much recovery you'll have. And if the failures of the future are more caused by natural catastrophe, the recoveries will be 0 all the time because all of the assets and reinsurance will be exhausted in paying the claims. And so we have to assume that recoveries are not a major source of good news for us. I hope that answers your questions.
All right, thank you very much, Lista, for that good presentation. Just for a basic, 1 or 2 issues from the side. So just to confirm that PASIC is a risk minimizer or just a pair box kind of, you can just confirm that. So from PASIC's perspective, how have you defined the failure trigger point that now triggers a resolution? And then finally, I hear you keep mentioning the court. If you could just share some experiences from Canada with the, I get a sense that your resolution arrangements are court-based. Whether if you could talk to that, if there are challenges from that perspective. Thank you.
Brilliant questions. So we're definitely more than a pay box, because we have the ability to engage in resolution activities prior to failure. I have negotiated confidentiality agreements with all 10 provinces and 3 territories and with the federal supervisor. And my independent directors are inside the tent working on problem insurers from the moment they're staged. The moment distress is signaled, we're already inside the tent trying to work out how we could avoid failure. The one thing I cannot do is use industry money to resuscitate a distressed insurer. They're going to have to exit the market one way or the other at the end. They're going to go out in a coffin, they're going to go out in a transaction, but they're going to go out. But I have definitely more powers than just pay box. And I would say if I think about the definitions from the FSB, we're more than pay box. We're not a resolution authority. Nobody in Canada is a resolution authority. I share the powers of resolution authority with our prudential supervisory partners. With regard to the triggers that you asked about, in the history of the Canadian failures, the red flags are very consistent. And if you go to our website, you can see our publications on this. But the first clue is that the people who run failed insurers aren't very good at insurance. So they consistently are underperforming from an underwriting perspective. So you can actually see long in advance the company's failing. That they fail in slow motion. It's like that Hollywood train crash that just comes in slow motion. You can see it coming for a while. Chronic underwriting losses is a fantastically powerful predictor. On top of that, though, you get these incredible cycles of premium growth and shrinkage. And so what you tend to see is management getting a lot of claims, so they rapidly grow so they can use new premium to pay old claims. It's kind of like the insurance version of Ponzi. And then they discover that they're really bad at pricing these new business as well, and then the claims get worse, and then they pull back desperately. And at that point, normally they raise new capital. It's amazing to me that they can find people to give new capital. Because if you're bad at insurance and somebody gives you new capital and you haven't got better at insurance, what happens to that capital? It disappears just as fast as the stuff before. And so you see this cycle of chronic underwriting loss, cyclical behavior around growth, and then fundraising efforts. And so those are all the kind of red flags that we look for, and I have a watch list, and we share our analysis of potentially troubled insurers with the regulators, and they share their list with us. So normally it's the same folks. But just to finish, the last one, in the last 18 months before a company fails, they grow like crazy. And that makes the problem for the guarantee scheme and the system as a whole way worse. There's one last desperate spasm. They enter new trading territories, they enter new lines of business with which they have no familiarity, and they just try and generate cash to pay old claims and somehow hope that life will turn out better. And so that's the Canadian cycle. In the research we have done internationally, I would say it's a pretty consistent story. And I would say that's primarily true what I've just described for property casualty. Life failures tend to have different triggers, and we haven't done as much research on that. So what I've given you is Canada specific and generalizable to property casualty. Your last question was around court. So yes, the Winding Up and Restructuring Act of Canada was written by our founding Prime Minister. We were founded in 1867. This legislation was passed in his second term in 1872. The legislation has not been changed since. It is a very old law. Now, he was an insurance man. He founded a property casualty company and he founded a life company. That life company is called Manufacturers Life, Manulife. It's one of the giant global players. It was founded by our founding Prime Minister. So it's actually a good law. And it properly puts policyholders at an elevated place in the creditor hierarchy. It's actually a good law, but it is an old law. That's what the courts have to work with. And as a result, when the prudential supervisor pulls the pin, it goes into the courts, a liquidator is appointed, and all the decisions after that are made by the court liquidator. However, I have a model wind-up order. In 12 of our 13 failures, we have successfully got the court to use our model order as the basis for the instructions to the liquidator. In 11 of the 13, we have convinced the court to appoint us as an inspector to the estate. In 10 of the 13, we have successfully recommended who the liquidator should be to the court. And as a result, historically, we've had quite a lot of success in influencing the way the court will manage the process, but it's still puppet and pushing on spaghetti sometimes. and no guarantee the court will do what you want. However, the reason the court is having to do this work is because there's no money left in this insurance company, and we have money. So we have quite a lot of influence simply because we are the solution to the court's problem about how to wind this thing up in the least messy way. I hope that helps.
We have 3 minutes to answer the 2 questions left. So we will start with her question, and then we'll have him, and then you can answer both within those 3 minutes.
Deal.
Please, I request those who ask questions to be upstanding so that we have them on camera, and to state your name and the company that you represent.
Good afternoon. Thank you very much for that very enlightening presentation. Very interesting. I know your focus was so much on the property and casualty insurance classes. My question is on life insurance. So I wanted to find out from your experience in the Canadian market, because you see there's a different provider for the life insurance guarantee. What model of funding do they use for compensation? Is it direct compensation to policyholders, or is it funding the deficit in the life fund and then transferring the fund to another provider? And then my second question, are there life insurance products that are excluded from compensation?
Right.
Thank you.
Final question, and then you can answer both as you conclude.
Thank you, Alistair, for your very elaborate presentation. My question is very brief, as has been alluded by our board chairman. My name is James Njogu from PCF. As has been alluded by our board chairman, we are in the process of coming up with a new legislative framework. I heard you mention in your presentation that you have resolution action, but you rarely use them. We intend to be more than a pay box, probably more than maybe pay box plus in our new legal framework. My question was, how do you relate with the industry regulator, including insolvency practitioners regulators, in resolving companies that have been wound up, to avoid conflict of interest or conflict of laws and mandates? Thank you.
2 great questions, and 2 minutes is going to be a test here. So, short answer to the life, we have had 4 failures since the life insurance guarantee mechanism was established. 1 big company, Confederation Life, and 3 smaller companies. In all cases, there was continuation. So the deficit was funded. That was clearly the solution, and it really is most of the time the best solution for life insurance, is to find a buyer for the liabilities and then fund the gap. There is some limits to the funding of that gap in the Canadian model. They have just been adjusted recently so that it'll be full up to 90% of the value, or $1 million. So add 2 zeros to that. So 100 million shillings of policy protection. And then with regard to your question of are there products excluded, generally speaking, the answer is no. It's broad coverage across both term, whole life, universal life, and employee benefits, medical, disability, etc. They're all broadly covered. There are limits around the guarantees for investment funds inside policies. But normally those funds are segregated, and so there's no loss for the policyholder there. And so that hasn't been a big design problem for us. Our folks at Assuris, ASSURIS, that's the Canadian thing, their website is also fantastic and also has quite detailed information on the failures they've managed. So I would recommend you take a look there. With regard to the question around resolution frameworks. Our partnership with the regulators is embedded in the fact that we exist in partnership with them by law. So the 10 provinces and 3 territories, they control our bylaw and our memorandum. No, our board can't change anything without those partners in agreement. And so it is a true partnership between industry and the regulators, but the regulators have the upper hand if there is a debate. Second, I have signed a memorandum of understanding with them all and with the federal supervisor that says that the moment there's a sign of trouble, they can bring me inside the tent and confidential information will be exchanged. I think I signed a document that says my children go to the government if I break my word. I go to jail. Everybody I've ever talked to goes to jail. Like, it's a very strict set of expectations around confidentiality, and obviously we take that very seriously. And that confidentiality extends to the independent directors on my board. And I have former regulators on my board. I have former investment bankers on my board. I have former ambassadors on my board. I have a very strong group of independent directors that are picked so that they really would be just the right group to help a regulator in a crisis. And finally, I have some powers and I have money, and both of those are useful to the regulator in a crisis. And in Canada, the thought process has always been that once the distress is too severe, the regulator really wants to distance themselves. So they're happy to kind of hand off the smelly problem to the industry to solve. And so that having all been said, we have never yet tested our full resolution powers. All my history is the regulator phones up on a Friday, says, I'm closing the company. I want you in court on Monday and bring your checkbook. I've never had the chance to test these powers, but that's exactly why we've been doing these desktop exercises, fire drills with my board and with the regulators to test out how it would work. Last part of that is I've been adding new tools to my toolkit. And number one of those is getting a charter for my own insurance company to sit in a drawer. But in a crisis where I have a company that's accumulated toxic liabilities or toxic assets, and I can't find a buyer for the company because there's one part of the company that caused the problem. But if I can transfer the bad stuff into my bridge company, I could sell the rest. And so the scenarios for splitting good company, bad company, and let me manage that in runoff and fund the runoff costs through my assessment powers, that's new tools that will be approved in the course of this year. So we've been thinking hard about resolution, but we've never, thankfully, have not yet had a chance to test them live. That's the best I can contribute on our thinking around resolution, given the time constraint. Happy to talk further separately.
A big round of
Thank you.
applause one more time for that wonderful presentation. Thank you so very much, and we appreciate and we're confident that we still have time with us to answer questions. Of course, our speakers are very accessible and very available to answer more of your questions. Even if you don't get an opportunity to fill them during a session, you can always meet them during our breaks and have this beautiful conversation and take a selfie while at it, just to crown the conversation. Now, we are going to dive straight into our next presentation that is, Ezekiel likes to call it one of the hardest presentations because it comes just before lunch. But he is a very interesting speaker with an elaborate deliver the very best. Ezekiel Macharia is a fellow of the Institute of Faculty of Actuaries and a fellow of the Actuarial Society of Kenya. He holds a bachelor's degree in actuarial science from the University of Nairobi. He joined the financial services provider Enterprise Holdings in the year 2016 as CEO and chief actuary in charge of the subsidiaries in Kenya, Uganda, Tanzania. Kenya is a leading financial services firm in East Africa, dealing with reinsurance, employee benefits, and the leader in actuarial advisory of insurance companies,
supporting pension schemes on investment policy statements, administration and post-retirement benefits. Kenbright has set itself apart as an insurtech leader in Kenya for digital insurance solutions, where it has launched the award-winning insurance aggregators for health and car insurance. In his professional career, Ezekiel has over 15 years experience in East African market. He's passionate about development of insurance and currently supports a significant number of private and public insurers as the statutory appointed actuary within Africa. I present before you a gentleman with great experience, prowess, and the ability to deliver it in articulate terms. Please put your hands together as we welcome Bwana Ezekiel Macharia.
I promise to take 20 minutes. I'm happy, Alistair, you really talked about some of the statistics that you have in Canada, so I'll benchmark. I'm also happy to inform you that we had a study paid for by PCF in 2022, so we'll give you some highlights there, because we're also able to do a study with the market to get coverage levels, so we'll be able to show you that. So on the next slide, just for me, I'll talk about why do insurance companies fail based on that study we did with PCF, and also just give you a highlight of why you need. And Alistair really talked about the need, but I'll just cement that discussion of why you need a guarantee scheme. Okay, so next slide. So some questions I want us to ask ourselves as we are listening to this presentation. It's just 20 minutes, and as we go for lunch, first question is, why are companies collapsing if there's a regulator, right? The assumption is the regulator, that there should be no need for collapse, but they are collapsing. We've seen that they're collapsing about an average of 20. Maybe I can give an interesting observation. When I was in campus, I did a study, and one of my thesis was the number of insurance companies collapsing is one company every 2 years. And I was just doing quick math on your stats, and I'm like, oh, I was right. Your number is about 2.5, so about 3. So they are collapsing. So the question becomes, why are they collapsing? And then the issue of resolution, is there a better way to do this, or do you just them to be dead and then we come in? And then the last part is, for the people who want to start PCFs in their market, just to take stock of where has PCF moved in the last 20 years. I know in Canada you had said, are you able to do 50-year celebration? We'd also like to know, where are you on your 20th year, so that you can benchmark. Okay. So the next slide is just a key highlight of, you talked about 10 companies in Kenya, so I'll just give you some highlights of some of those companies. Of them, and I'm just looking at the past 5 insurers were general, and we also looked at the market share when they were collapsing, and in total there were about 14% market share. So this gives you an idea of what kind of collapses we're experiencing. And an interesting discussion in Kenya, most of those collapses were from motor class, right, and medical recently, but most of them were motor. Then the question becomes, should motor insurers pay more for the cost of recovery? These are discussions that we're hoping, as we go into the future, we have a resolution mechanism where maybe if you write motor, you pay more into the fund, because most of those failures will come from motor. And then we have a few of life insurers, but you can see also the market share on life is a bit low. Now, if you have to ask yourself, what is causing failures? It's there, or all right answers that you can guess. You can see them on the screen. Whether it's underpricing, reinsurance, rapid expansion. I always find it interesting. Insurance sector is where rapid expansion is a bad thing. If you're in manufacturing, that's a good thing, right? But in insurance, rapid expansion is actually a sign that things might not be moving on. Why? Because of the issues we know. you undercut to get more money, and then vicious cycles comes in, and then you're dead in the water. Okay, next slide. So I wanted to give you some stats that a bit more global, to just give you an idea of what causes collapse. Now, life is the blue, dark blue. Non-life is the light colors, and you can see, yes, there's some reasons that are the same for both, but actually, for a life company, that mismatch, economic conditions and asset liability management, the top two. If you're a life CEO, just know those are your two biggest causes of collapse. It's not whether you're reserving correctly, or there's some CEOs who come from general and life, and they think reserving is what will kill you. In life, economic cycle, the central bank deciding to do what they want to do, and you mismatching liabilities. For example, you write whole life policies, you give a 9% guarantee, and then your assets are in a class where you're not getting the same. So that is a reason for life collapse. And so the question is, can the regulator stop you? The question was, if a regulator, can the regulator stop economic cycles? Can they stop? I saw the regulator issued some liability matching, but inherently, mismatch has some economic issues inside it, right? Because what makes an asset liability mismatch really go heavy is because big issue. We saw the bonds, the yield went up, then the valuations dropped, and we saw a lot of companies declare negative returns of pensions. So there is an economic cycle under it. On the insurance side, at the top, you can see that reinsurance and claim deviation risk are things that will kill you, right? Now, I would consider that more of a catastrophe. The reinsurer was not enough, or there's a deviation exposure. So that also shows you that the regulator also, yes, they can look at prudence, ethics, following up on structures, but they cannot stop a catastrophe, right? So there's also that aspect that there is an issue. So if you look at life companies, market risk economic, and lots of business also is there, but regulator cannot really stop some of those key areas, and that's where a scheme comes in. In general insurance, yes, we have issues like fraud and pricing governance. They are there, but the key factor, I would say, would be on your catastrophe costs and your insurance. Okay, next slide. The third aspect of why insurance companies fail is trying to be a superhero, right? So things have gone bad. You see, where does it all start? Events. Insurance companies, apart from the ones that obviously are just bad governance, and we forget about those ones. Let's talk about economic issues or a catastrophe. They all start with economic events. We're seeing in motor, so you also underprice. You see, the event is you tell your board, everybody is undercutting, so let me also undercut. You see, that's an external event that you're responding to. Another external event is economic scenario where you're a life company, the yields have gone down, or I don't know if you have any representative from Ghana where there's a haircut on bonds, and then now that's an external event. So we'll talk about how you react to it. Internal events are fraud. You can have fraud in your company. You can have under-reserving. You can have weak management, fast expansion. Those are also internal events. They all start there. The difference between a successful company and an insolvent one will be how they react. And the key word is hiding. The insurance that hide the problem most of the time go into insolvency. The ones that are transparent and quick to decide and early intervention normally survive. So on average, when you see a company having external events happening but they didn't react like everybody else, that means they went to the red zone, which is weak action or inaction, right? Or a CEO who's never in office and everybody else is managing. They don't even know what's going on, right? Just want to have a title of CEO, but they don't know what's happening in the business. So what happens is that there is no action. And what are the issues? Unaware of the problem is one of them. Hiding the problem is another one. And high risk, let's take a gamble. Let's undercut and get more risks. Or let's double down, let's take our money and buy bitcoins. Maybe it's they succeeded, but maybe you bought the wrong coins and then you end back to zero. So gambling, and trying to see how that will be. In Kenya, bitcoins are land, for the ones who don't know. And so you always go to land and see whether you can make a quick win. So this is one of the areas that you'll see that causes insurance companies to collapse. Next slide. So that's really where the guaranteed schemes comes in. So we're not saying that the regulator has failed. We're just saying there are some external events that happen. And if you look at how PCF is structured right now, the compensation model, we just talked about it, used to be at 100K. Now it has gone to 250. We'll talk more about that. In fact, the reason for the study that Ken Bright took was to see whether we can make that 250 more from an actual perspective. And the issue of other markets, other jurisdictions, just to highlight, some look at corporate schemes versus individual schemes. I think Alistair just gave the example that they don't look at corporate schemes as much. They don't look at aviation. In Kenya, it's 250 for everybody, whether you're in aviation or you're in motor. But in your market, you're focusing more on personal lines. You're saying, okay, I'll not support the large businesses. So in Kenya, yes, the structure is a bit easier to follow because you just have one number for all. Next slide. So when you're looking at resolution, and one of the areas we really want to, if you had the act is being amended, is to support from stage 4. You see, from stage 1, stage 3, that's where the regulator will be strong in. But from stage 4 to stage 6, there has to be a conversation of supporting insurers. Like in PCF now, we have about 25 billion. Yet you can find an insurer who just needs 1 billion to not collapse. But then we are like, no, that option is not there. So let's let the insurer collapse and get liabilities of 5 billion. And you see, those are the numbers you have to think about. Do you support an insurer with $1 billion in capital and avoid its collapse, or do you let it collapse and have the liabilities at as 5? And those are the conversations that you start thinking about. And I can give you a very simple example. When you have an asset liability mismatch between your life business, where your liabilities are earning maybe 9% and your assets are earning 4%, that gap is just growing. But if you had funds, you'd be able to reorganize your assets. But you can't reorganize your assets without taking a loss. And that loss is what that 1 billion would, for example, pay for. So those are the conversations you want when you have a guarantee scheme. Next slide. So these are some of the, if you were to look at it from 22 actions, from the easiest ones, the heavy blue ones are more of regulators' work, and the red zones are more of guarantee scheme work. So there's a middle point where guarantee schemes can come in, right? Examples of intervening, recommending this insurer to be bought by another insurer. Now, those are the things that I would say is missing in most markets when you don't have a guarantee scheme, because even if you want to sell a company to another company, you may, as a regulator, you have no funds. You cannot force somebody to buy a company. But if you tell them, buy this company for 80%, I'll pay the 20% balance. Now that is where the guarantee scheme can come in, because they will have the funds to support that transaction. So, and that's why you're seeing there's an overlap between regulator and guarantee schemes. Yes, a regulator, I've put the map to the bottom because, yes, in Kenya, it's up to the black area, but in other markets, you might find regulators are going beyond that. But the message here is that a guarantee schemes will help a regulator intervene in terms of selling that book, in terms of supporting it, in terms of administration of its those are some of the areas that guarantee scheme needs to really come in. And when you don't have a guarantee scheme in your market, then you start seeing there's a gap of saving companies in terms of saving or resolving failures. Next slide. So I also give you some aspects of how Kenya compensates. We are 20 years now as PCF. We don't cover everything. For example, we don't cover refund of premiums. That's one of the areas. Do we refund premium? No. That's one of the study aspects to see whether refund of premium is a possibility. I think it's obviously to address issues of fraud. We also want to only have fully documented claims. However, it doesn't cover things like IPNR, which is claims on the way, right? Claim that reinsurance is supposed to pay the reinsurer collapse. Those are some of the things that PCF doesn't. But the message here is that PCF is 20 years old, and PCF covers this. As PCF grows and becomes larger, it will be able to obviously put more yeses on this table. Next slide. So we also did that earlier. So that example you showed us 98%. So this is our number today. So our 250,000, that's about $2,000, actually covers, from account perspective, about 21% of policies fully. So a fifth of the policy holders are fully covered at that $2,000. But yes, there's obviously a gap between, yes, so we are thought of, at the top there, we're showing you the count of policies, and here we're trying to show by sum assured, if you were to cap it at 2K, 250, 300, 400, 500, and now 500,000, if you were to double the compensation cost, you'd be able to move from about 21% slightly to a higher number. The people who are partially covered are another 6%, right? So 21% are fully covered, and then another 6% are partially covered, right? Obviously, we'll talk about the classes, but yes, there's that coverage level that is there. Next. So this slide shows you by class, where you showed us 98%, 97, 96% coverage. So, but remember, you don't cover aviation. That's the first slide. You don't cover that. But in Kenya, we do cover under PCF. But you can see the average claim size versus the compensation. So we are at 0.1. You don't cover, but we cover 0.1. So that's the advantage. But you can see for, so if it doubles, let's say to 500, you can now start getting to the 40% levels, right? Just to give you an idea, an average car in Kenya is about $10,000. So at $2,000, you'll start seeing some coverage support. So to reach half $500,000 to really get into those coverage levels. Obviously, lowest coverage levels observed are on the classes you don't insure. But I think for us, there's an issue of equity. In Kenya, we love equity. So whether I'm the richest person on earth or poorest, excluding people in our market is a very difficult thing. So yes, they have a low coverage level is because it's a fixed 250K, and then the coverage level varies. So you can see life assurance is also a high coverage because the contribution rates are also low. There's some two areas that we don't cover at all. We call it superannuation, which traditionally is your pension business, so that's not really covered at all. But the scheme, you can see, majority covers what the Canadian structure has, plus the complex risks, that's also covered, even though effectively to a small percentage. Okay, so my last slide is the conversation of can PCF refund premium. So in the study for 2021, 2022, because PCF is a government entity, which is June, so we had to use the December 21 stats. This just shows you life company versus versus GI companies, and you can see that on average, the liability, if PCF was to say we'll refund you your money, you'd need about 182 billion shillings in Kenya, but at the time PCF had about 18 billion. So from a refund perspective, even though we might say PCF at the time had 18 billion, that was only 10% of refund, right? So there's a potential, maybe by the time you're reaching 40 years of PCF, maybe we will get to refund of premium. But as of now, I think the focus might be more of enhancing the claim side, not the premium refund. But it's a journey, and I think for the people who have not started their recovery schemes, you know, the fact that you've not started is a problem. Starting is what is recommended so that you can start building the fund. So from a collection perspective, I think PCF might be, from our calculations, in the next 15 years, be able to at least get into a good coverage level above 50%. And then beyond that, it can go to refund of premium. I saw in the Canada numbers, you're showing 2,500 for premium refunds. I think in Kenya, to get to that number, right now we're at 10%. So getting to $2,500 might need maybe, you know, maybe when PCF is doing 75 years celebration, maybe it can provide those numbers. So with that, my time is up. I just want to thank you everybody for listening to me, and happy to listen to any questions. Thank you.
Very well. Close as we do that. Very well. You've done it very, very well. Like the actuary you are counted for every minute. Okay, let's see. Do we have questions for Ezekiel? I'll take two, and because he's young enough and vibrant, he will take them all and answer. Let's have the questions in 5, 4, 3, 2, 1. Well articulated.
Lunch.
A big round of applause one more time. Thank you. Thank you very much. Thank you very much. We appreciate it. I'm going to take it to welcome Bwana Chair. I'm sure there are some people you may want to recognize before we proceed for lunch. Let's give Bwana Chair a round of applause, Honorable Simon Azee.
Thank you very much. I want to take this opportunity once again to thank our presenters this afternoon. We've had a very good presentation and quite enriching. So we have visitors from South Africa. Where is the international delegate from South Africa? Can you please stand up? It would be wrong for us not to recognize you. You've come all the way. It would be very wrong for us not to recognize you. So can you say a word? Just say hi, who you are, what your name is. I'm stealing your minutes for lunch. Just.
Good afternoon, everyone. My name is Andu from the Prudential Authority within the South African Reserve Bank. I'm responsible for enforcement and resolution of banks, well, limited extent, but insurers, great financial institutions in South Africa. What else? It's
Thank you.
nice to be here. Thank you for the warm welcome.
Thank you and welcome to Kenya. The next guest is from Malawi. Malawi. Your name, the institution.
All right.
Sound.
Thank you very much. My name is Sohan Kondwe. I'm from the Reserve Bank of Malawi. I'm the director for Financial Sector Regulation Department, a department that is responsible for licensing as well as resolution of financial institutions.
Thank you. Thank you very much. The guests from Tanzania, the delegate from Tanzania.
Hello, everyone. I'm from
very much. Rwanda?
We still have one more from Tanzania.
Oh, another one from Tanzania?
Yes.
Okay.
Yes.
Good afternoon, everyone. My name is Alex Rocky. I'm from Tanzania Insurance Regulatory Authority, Directorate of Supervision. So that's the directorate which is responsible for the registration, licensing, and also resolution of insurance companies.
Thank you.
I'm happy
Thank
to
you.
be here. Thank you very much.
Thank you so much. Our brother from Rwanda.
Good afternoon. My name is Roberto Marcel from the National Bank of Rwanda, specifically from the department in charge of.
Thank you so much. From Rwanda again.
Yeah. Good morning. Good afternoon. So afternoon. I'm heading the Deposit Insurance Fund for Rwanda, which is under Central Bank, and we are yet to establish the PCF. So we came here in 2022 just for purpose. Thank you.
Thank you. Thank you so much. We are learning a lot.
We still have one more from South Africa. We failed to recognize that. Just one more.
Okay.
I thought I was going to get off scot-free and save you time for lunch. But my name is Puelano Heledi. I actually work with November Department. Thank you.
Thank you so much. Uganda.
Good afternoon, everyone. Happy as Namanya from Uganda Insurance Regulatory Authority. And for us, I have good news because we are in advanced stages of having this fund established. So our being here is not only important but also timely. So I'm happy whenever I hear all the success stories from Canada, from Kazakhstan. I feel happy about this, and we are really coming on board.
Thank you. Thank you so much. Another Ugandan.
Good afternoon. My name is Najib Juko. I work with the Insurance Regulatory Authority of Uganda.
Thank you. Thank you so much. I'm being informed that Malaysia are joining us virtually, and also Nigeria will join us virtually. So I don't know if I've left anybody. Have I left anyone out? Any other country that came without most probably our knowledge? So that's it. Then I take this opportunity once again. I've bought for you very good lunch. So karibu lunch. Welcome for lunch. Thank you so much.
Thank you very much, Bwana Chair. We appreciate those wonderful and insightful remarks, as welcome our guests from all over to be part of this noble cause. Ladies and gentlemen, we have eaten into a bit of our lunchtime, but all for a good cause. I believe we have had great insights and a great conversation, even as we've been able to look into our program incisively so far. I hope you've gotten the nuggets. You've been able to tap into the great insights. And as we now get to our lunch, we will be proceeding for lunch at the first floor. So we'll get out through this exit and proceed to the first floor, just on top of this place. And then lunch will be served. Our ushers will be there. They will guide us appropriately. And because it is 20 minutes to 2 o'clock, we'll have our lunch up to 20 minutes past 2 o'clock. So we'll have 40 minutes of lunch. We have enough serving points. Will allow us to consume that. Let's do it as fast as possible, and we resume and begin our program at 20 minutes past 2.
Include conducting actuarial assessments to ensure the financial soundness and sustainability of insurance companies, analyzing company data to identify early signs of solvency risks, and overseeing companies under special regulatory measures to ensure timely corrective actions. He also reviews actuarial reserving practices, claims payment patterns, and premium rating structures to ensure alignment with prudential requirements. In addition, he recommends and supervises remedial measures for insurance companies that have fallen into solvency deficits or have become insolvent, guiding them through the recovery process or resolution frameworks. Alex holds a bachelor's degree in actuarial science from the University of Dar es Salaam and a master's in insurance and actuarial science from the Institute of Finance Management. He is also a certified risk management professional and has over 10 years experience in actuarial and supervisory work with the insurance and pension fund sectors. Welcome, Alex. Have a seat on the fourth chair. Last but not least, we have our very own regulator with us today to share some insights. And this is Mr. Bernard Gitangi. And please clap for him as he comes on stage. Mr. Bernard Gitangi is an insurance professional, having worked for 28 years in regulation and supervision of insurance industry here in Kenya. He is a fellow of LOMA and certified mediator with vast experience in ensuring insurers adhere to good corporate governance practices and ethics. He is currently serving as manager supervision licensing at the IRA here in Kenya. Let's appreciate Mr. Gitangi. Welcome, you can have a seat. I think I will request maybe so this should be a discussion, and of course, as members of the audience, you can note down any questions that you may have for the panel that is before us. And I'm sure quite a number of us saw the statistics earlier in the day, where we saw failures in maybe jurisdictions that are represented here, and you may want to know more. How are these companies resolved? So the aim of this session is to stimulate insightful discussion, highlight cross-country comparisons, explore best practice, and hopefully learn from each other. So we've structured some questions along, these are 5 thematic areas. In your various jurisdictions. We'll also see whether there's a role for an insurance guarantee scheme in your jurisdiction. For regulatory intervention.
Thank you. So the objective of the Prudential Authority is to also promote and enhance financial safety and soundness in our financial institutions, as well as assisting the Reserve Bank in maintaining financial stability. So with that in mind, I mean, we tend to use a proactive, risk-based, forward-looking type of looking in terms of failures. So while it's not encoded in the law, but I mean, once you start seeing breach of prudential requirements, then you start raising eyebrows. Once we start seeing protracted requests for extension to submit bid returns of financial, those are some of the concerns that something may be off track here. Definitely the ratio is one thing that we look at, but obviously we use that jointly with qualitative measures as well. In statutory management, curatorship, and in statutory management, curatorship, and
establishes a trigger through which now you as the regulator would intervene.
Thank you very much, Mr. Moderator. So for Malawi, the straightforward answer is no. If you look at our Insurance Act, you may not necessarily see failure defined in there.
Requirement, especially with the T1 solvency. Over time, you always actually request for capital injection, or maybe sometimes when you request for any corrective measures, and then resistance or persistent crisis or persistent situation whereby the company remain undercapitalized, and see this company actually doing. And then, again, another indicator that's of course, as I can see, is interlinks to the categories profitability. Profitability actually affects in one way or another the level of solvency, the level of capital. So when I think that something again that has been raised by Ezekiel is these things of actually underwriting losses or maybe under provisions, at actually at a given time they will end up by hitting the level of solvency of the company at a level whereby the company can end up by falling under the minimum threshold. So what do we do in terms of actual intervention to prevent that here? We have actual intervention measures whereby depending on the level of actual capital, we say this actually is normal, and then we just actually have minimum intervention measures. But when it starts falling, like from this level to this level, we say, okay, we need to request the company to submit to us maybe a kind of recapitalization plan. And then when it continues actually failing, we not only we request the board to submit recapitalization plan, but also setting a deadline whereby beyond that the deadline, then it can give us now later room to intervene in terms of administration.
Thank you very much. That's a very key insight in terms of the ladder of supervisory intervention which you apply, and I think that is what your colleagues have echoed. Maybe Mr. Rocky, you can tell us how it is in Tanzania. Is it defined within the law?
Thank you very much. I will not differ much from indicators which we monitor, including solvency of companies. We monitor the companies, how the pattern, how they pay claims, their business, how they're growing, their profitability. So all these, we measure that, and they will indicate, and they will start showing that this company is going, is starting showing the problems. For instance, the solvency levels, we have the different levels which we took measures
that shows that this company is in the downfall of becoming a company that can be declared it has failed. One of the key thresholds that we check is on the issue of capital adequacy ratio, which check on the solvency of each and every company. Within the Act, we have the threshold within the sections of the Insurance Act. We have even the regulation that define that if you get to that certain level in terms of capital adequacy ratio, we are required to do a review action so that you can be able to meet the threshold. To be expressed, require the threshold of you are supposed to be at a minimum of 100% capital adequacy ratio at all times. So any company that go below 100, as a regulator, it become an indicator that this company might be on the downfall of failing. So that is the critical element that we check. And then we engage the insurance companies to ensure that they are able to fill the gap. If there is a gap that might have been identified, that the reason why your capital adequacy is going down might be the issue of asset liability matching. We have what we call some risk charges that accompany the issue of calculation of that model. So that is the one of the things that the regulator check, and we find that if we find that the company is on the downfall of below the 100%, it become a great trigger that this company might be on the fall of failing. The third element that we check, the very critical one, is the issue of corporate governance. What we have realized is that a company might be very well capitalized, but in terms of governance within that company, it is not really being well governed. And what we have within the Insurance Act, we have some intervention in which are well stipulated within the provision of the Act that the director, the mandate, can be able to tutor and check what might be causing that and ensure that we streamline that company. So it is those are the kind of the figures to find that the company getting down. Thank you.
Thank you. Thank you, Gitangi. And leading now to the next, you've talked about intervention measures that are applied when a company is still licensed or still operating. However, now a failure has occurred. So we can just listen to the various jurisdictions, what kind of resolution mechanisms are available for them, maybe starting with Obambo. The company has failed, probably you have cancelled the license. What resolution mechanisms do you have to work with?
Thank you. So in South Africa, the whole resolution regime is relatively new in the sense that previously we just used the court process. So we started with the bank regulation resolution. So in terms of insurers, it's still very much going to court, maybe applying for liquidation, putting that company on liquidation. But before you take it to liquidation, it would have gone through either a statutory management process and or a curatorship. So we've had, for example, institution, non-life insurer was put on curatorship because they were just concerned around just the numbers that were coming through from the institution. So we appointed a curator. I think within 2 weeks, the curator was there, like there's no reasonable prospect. So it was quickly put on liquidation, and we closed that up in that way. But in sadness, where there's still hope, then no recapitalization, restricting the businesses, sometimes even suspending license while they get their house in order, or even withdrawing the license. But where there's a case of a license being withdrawn, then say moving those, transferring those policy holders into another one that is still solvent. So we do get cases of either solvent runoff and insolvent runoff where there's issues with an entity generally.
Thank you, Nobambo. So you do have an array of tools that you apply, be it transfer, solvent runoff, insolvent runoff. Be going to Dr. Gondwe.
If I may. So part of what we're doing now is just to doing these reforms, because currently, like, the transfer is not enabled in the legislation, as it say, so it becomes more the moral suasion at this stage to say company A, you are in trouble, can you talk to company B? So part of what we're looking to do go forward is to enable those powers within the regulator. But in our work that we're doing is that you almost need to have a way, say, transferring to company B, but perhaps company B wouldn't have ordinarily wanted that kind of risk, and that's where a guarantee scheme comes in to say, okay, this is not within your normal risk appetite, but here is a little something to bridge that gap. So we're not quite there yet, but it's something that we're definitely thinking about right now.
Thank you very much, Nobama. Those are very interesting insights. Going to Malawi, the Malawi experience, Dr. Gondwe, Africa has had what resolution options do you have? Do you have similar models to what South Africa has, or what do you apply once a failure has occurred?
Yeah, thank you again, Mr. Moderator. Not very different. So, as you know, the understanding is that once the institution is declared as a failed institution, the presumption is that all the other supervision failed. So, the organization has failed, turning around has failed, management changes has failed. So, you would then move to the actual resolution issues that we talk about. In terms of legal framework, we have a wide range of those issues. For instance, the law that we can wind up the institution, and I think the key enhancement that we have done ourselves is that the winding up arrangement now is no longer requiring court kind of sanctions, which is a big plus from our side. I think Alistair mentioned one case that he demonstrated here. That case, we took a decision to wind that institution down in 2011, but we don't go to get the permission to proceed doing certain things on that aspect. But we also, the law also allows us statutory management. It also allows us a wide range of for instance, we could transfer the business during that time of statutory management. We could force a merger during that time of statutory management. We could do even bridges institutionally provided, but it's provided for in the law. What is not provided in the law is the explicit provision that allows for government bailout, or either way, whether temporarily a capital support or temporary liquidity support. That provision is not explicitly provided in the law, perhaps for good reasons. So in short, that's what I can say in terms of the available tools and options that we have in Malawi.
Thank you, Dr. Gondwe. Those are very interesting insights, and I think a lot of us can learn from your jurisdiction in terms of what you have actually legislated as resolution of. Moving to RSL, maybe you can tell us what tools are available to you once a company has failed, you've applied your mentioned measures. What
of the regulator, whereby the regulator we will be now involved. There is one to start now organizing transfer of the portfolio. And then in that process, what we do is to start ranking existing insurance companies with indicators, and then them from 1 to 5, with 1 being the best and 5 being the worst. We have solvency, liquidity, profitability, a number of indicators, so that once we are done with rating of the insurance companies that are still solvent, and then we have to organize transfer of the portfolio, then we will start by choosing by the one that are highly rated, and then and so on. That is second. Now after that process, now then the regulator has the power to now appoint the liquidator, which we take now the insurance company into the court, so that now the liquidation of the company is actually organized. We also have one tool that is still in pipeline, our PCF. Actually, we did actually a good job during the last 2 years. I think actually starting by a study tour that was actually conducted in Kenya, whereby we've been inspired by Kenyan model, and then we came up, because since the insurance law delegate the power to a presidential a PCF. So we have drafted one that is actually at final stage of being approved, and then after that we also add that tool in terms of actually intervening whenever an insurance company failed. So this one is yet to be issued.
Thank you very much, Asel. That's very interesting to learn that you're at an advanced stage of developing your insurance guarantee scheme framework, and also there's some convergence between in terms of appointment of liquidator. I'm curious about what happens in Tanzania. Do you have, Mr. Rocky, I think you talked about statutory management. What other resolution tools do you have when a company collapses?
Thank you. Once again, what we do mostly is to ensure that the companies, these insurance companies, do not reach to the point of being bankrupt. But if it happens, the law now provides tools for at least some amount to protect the policyholders. For instance, the insurance regulation, our insurance regulation, provide that 50% of the minimum paid capital of the company should be invested with the Bank of Tanzania, Central Bank, of which that amount cannot be accessed without the approval from the Commissioner of Insurance. So that is at least give us some amount to compensate, and that amount will be used only to compensate the policyholders. So it's more in terms of ensuring that the policyholders are well protected. And for the numbers, it's not much, but for the minimum capital for insurance companies in Tanzania, almost 1 million USD. For insurance, it's 4 million USD. So those 50% has to be kept with the supervision of the commissioner. So there's no way that the insurance company will access that amount without the approval from the commissioner. So that is also what we are relying on to even if the company has been bankrupt, that amount can be accessed and some of the policyholders or partly of the claims can be paid. But then again, the gaps exist also, as we see that the law does not provide that how much now can be compensated to those policyholders. So I think it's something we can work on it, and we've seen what is happening here and the model that you are using. So at least we have some amount, but I think we need to increase on that. So that is the tool mostly which we rely on to institute these companies which have been failed. And I can assure you, we saw that what company failed in our country, the challenges are still the same, that the court has not yet made a decision. So even that amount cannot be accessed. So the holders are still not yet being paid. So those are the challenges.
Thank you very much, Mr. Rocky. That's very interesting in terms of the availability of actually some amount that is held with the central bank to be used to compensate. Going to Mr. Gitangi, maybe you can just tell us what the resolution mechanisms are available within this market for the regulator to apply for companies that have failed.
Okay, thank you, Moses, for that. Once a company fails, at least in our market, type of business, we have the short term, that is the general insurers. The most companies that we really witness them failing, and the two options that are there is, one is the statutory management, and once a company has been placed under statutory management, the statutory manager has two ways. He can be able to study and see whether that company can be able to be revived and do a report back to the commissioner, giving recommendation on what they have been able to discuss with the shareholder in terms of whether the company can still be revived even after that failure. But what we have witnessed in the past, we have not been able to have such kind of a situation, is where the statutory manager, after doing the statutory management for the first 6 months, they are able now to either apply for the liquidation of that company. But with the change of the law in 2019, it now became very easy even to do the compensation even without going to court, where now the policyholders compensation fund can be able to call upon the claimant and be able to pay all the claims that have been documented and are reported within that company. So the issue of statutory management within our country is now working very well. It's only that we still have some gaps which we are going to highlight, but in terms of statutory management, the law and the Insurance Act, where the PCF is established, is supporting the issue of statutory management. The other element for the short-term business, we have an element within the law that provides the issue of what we call closed fund of life business. The regulator can be able to draw a scheme and a closed fund, an insurer that has failed to do business so that they can be able to transfer that business to an existing insurer. So those are the elements that we have of institution of companies within our market. Thank you.
Thank you very much, Mr. Gitangi, for highlighting the Kenyan experience. Going back to Nobambo, a failure has occurred, you've applied a resolution option, either curatorship, statutory management. Maybe you can tell us what has been the experience of policyholders and claimants. Is there any protection mechanism offered in place?
Yeah, so to date we don't have a policyholder protection scheme of any nature. So the instances where life then it becomes move over to another insurer, but where there is a life cover, a life insurer that has gone down, I'm trying to think also, but there hasn't been any protection. So we've recently established a bank depositor insurance, which we hope over time will also introduce a policyholder protection. But this is a journey. We're here to also to fast track our learning curves and take some lessons that have happened in other jurisdictions. And equally, I suppose for South Africa, the whole notion around insurer penetration is still quite low. So it almost becomes the insured that are well off than, you know, so the issues for us tend to be more around even us. So we have a different type of problem. I mean, not to say that those who are insured don't need protection, but some of the issues that we face just lie at the people that just don't have access to insurance. I mean, you may or may not know that I think a year or two ago we had floods, just so many properties, etc. And some of the people, they were just protected, didn't even have insurance to claim. So I would say for South Africa, the issue tends to be more around perhaps access and penetration in terms of insurance products, rather than issues of policyholder protection. But we need to address both elements of it. I mean, it's more knowledge that South Africa, as a member of G20, was the last one to have even a deposit insurance. So our deposit insurance talks more around depositors. It's still 1 year old. So it's something that we definitely working on, and happy to hear other experiences around claimants and policyholders, how they were covered. Thank you.
Thank you very much, Madam Nobambo. Dr. Gondwe, maybe you could quickly highlight whether you have any protection mechanism in place for policyholders and claimants.
Yeah, thank you again, Moses. No, so the answer is no. Malawi, we don't have the policyholders compensation fund. So if you ask us about the experience, the single experience we have had was an unfortunate experience because generally policyholders suffered a loss in that case because we had nothing to do. As you're aware, when we're saying that an institution has failed, basically what we're saying is that the value of its assets is far much less than the value of its liabilities. So in the absence of any PCF, what it means is that even liquidation proceeds in that scenario won't be enough. So in the single case we had to do a haircut. So only about 30% of the policyholders' funds got some kind of like a payout from the lead to liquidation proceeds that we would have gotten. So this is an eye-opener. That said, though, Malawi seems to have taken a different model from the rest of the region, because remember we in 2023 and 2023 we set up the first deposit insurance scheme. The way we designed it is that we are first of all picked on banks, but the policy direction from the government was that we create the different funds along the same institution to cover the different of the financial institutions. So eventually the law provides that the board of the Deposit Insurance Corporation could probably 4 or 5 years from now, then they can take on board insurance under the same umbrella institution. And I think the reason for that is because unlike our colleagues, I've seen Kenya, I've seen Tanzania, now we were more or less like a super regulator. So we don't have a separate insurance in-house regulator. We don't have a separate pensions regulator. All these entities are actually within the central bank. So in terms of a protection mechanism, safety net, then the policy, okay, create one institution, but then allow time. And now this institution is set up, probably the insurance sector would be able to be accommodated and the policyholders' funds could be protected in that context. But I think in terms of priority of rankings, the law provides that they are ranked a bit proud. They are given priority rankings in terms of when there is liquidation at the expense of unsecured creditors. So they have got good ranking in terms of the law. That's what I can say. Thank you, Moses.
Thank you very much, Dr. Gondwe. Maybe Asel, you can quickly talk about whether you have a mechanism in place to protect policyholders and claimants.
Yeah, actually, as I said, actually, ours is still actually in a pipeline. Maybe as to share some key aspect of it. One is in terms of administration. Actually, we are planning to host it under the central bank as it will be new, and then as it will be growing, then one can see how to now make it as standalone entities. And then, of course, in addition to the organization, then we'll have an advisory committee that will be made up of representatives from insurance companies, rep from the insurance brokers, from the Ministry of Finance, and the National Bank as well. And then also in terms of funding, one is we have a provision of 0.1% for life insurance product, and then 0.3 for non-life, which is in general, and then compensation. Actually, after conducting a survey in terms of claims experience, we'll be capping as we start. We'll be capping at around 500 US dollars. That is around 500,000 Rwandan francs for life insurance, and then 1,500 US dollars around for GJJ as a cap. So now maybe sharing then maybe just a little maybe the experience on the two companies that were about to fail, but where we kind of rescued. One was, of course, after breaching the solvency margin requirement, we put it under statutory. And then when we were actually, sorry, as we're in that process, organizing actually transfer of the portfolio, as well as seeing whether we'll have to appoint a liquidator. Like enough, actually, there was actually an investor. Of course, even before the company actually being put under administration, there was a negotiation with an investor, but they could not agree on some of the terms. What we did, since we were appointed as administrator, we were involved in the negotiation and then try to be flexible in terms of the amount that the new investor would inject. So we actually offered them a kind of gradual injection of actually capital to the new investor. So we end up by having a new investor. So the existing one exits, and then with a new one having acquired the company. So that is how the first company was rescued. The second one, we definitely, the government through the Rwanda Social Security Board had to kind of acquire it and inject fresh capital.
Thank you, Asel, for sharing your experience in terms of your legal framework and also resolving the institutions that have failed in the past. I think, Mr. Alex, you had talked about the protection that you currently have, which is through the deposits within the central bank. But nonetheless, maybe I can move to the last question, which is, and we can start with you, Mr. Alex. In your view, what would an ideal resolution framework look like for your jurisdiction, as well as what protection mechanism would you consider to be ideal for your jurisdiction?
Thank you. I think we have seen the different models like today. For instance, the one that PCF has, and also from Pike. I think for us, we need also to improve what we have, because having that only that amount and the mechanism to distribute it is not yet finalized, I think it's quite a challenge, because the policyholders, they are protected somehow, but not well protected, because even if the company has gone bankrupt, it means even the capital is not enough to, the company is in insolvency. It cannot meet the liabilities. So 50% of the paid up capital will also be very insignificant in terms of compensating the policyholders. So I think for us, we are learning, and we are actually grateful for today, because we've seen different models which we can also study them more and see how it can apply in our part. But maybe I should also touch a bit on the policyholders' compensation, because the role of the regulator is to ensure that the policyholders are well protected. So in our jurisdiction, we also have a number of interventions which we do, especially on claims management. We really look on how the claims are being managed and processed, so to ensure that claims are paid in time. And also the amount of compensations, we have a number of issues which we've done, including producing the minimum compensation rate, especially we studied with the bodily injury and death claims. So all those to ensure that the policyholders are very well protected. And on top of that, we have the Tanzania Insurance Ombudsman, who also is available here with us. So these also to make sure that the policyholders are very well protected. But we see the model which we have, because it's specifically for compensating the policyholders in case the companies failed. And we don't have that much in our jurisdiction. Yeah. Thank you.
Thank you very much, Mr. Rocky. I think you can pass the mic to Mr. Gitangi, maybe to give his parting thoughts on what he would think an ideal resolution framework could be, and possibly maybe any enhancements that should be made to the protection mechanism that currently exists through the PCF.
Okay, thank you, Moses. I think for Kenya, as we have put it, we have the mechanism on the issue of dissolution of companies and protecting the policyholders. And the first and the foremost is that the threshold of the amount that has been put of 250,000, it has not been sufficient. With the data that we was presented this morning, we saw that it is almost between 20% to 30% of the kind of the claims that are there. So for us, because that amount was set allowed 20 years ago, and things have really changed. It is a matter of us having a conversation as we do the issue of revising the bill for the PCF, whether we can be able to enhance that kind of amount so that at least we can be able to increase the kind of the coverage that is going to be covered under the threshold of what is being paid to the policyholders. So I think it is a debate that is there, and I hope that with the time, because of the issue or even of inflation, it can be enhanced, and so that now the policyholders can be fully compensated to a certain extent, even if not the full amount, at least to a certain level of percentage as it was being projected. If it can be able to be 40 to 50%, if it can be tenable, that can be enhanced and it can be good. The other issue that has also been a debate is when a company fails, the existing policyholders, the company has been declared that it cannot continue issuing policies. Now those policyholders, they are left unattended, and they are required to buy new policies to cover the risk that they were covered by that insurer. So the issue of whether the refund of the premium pro rata can be done, it is a debate that also can be done and enhanced within the framework of our registration to ensure that people does not really suffer so much, because at the end of the day, that person had already committed money and they had already bought a policy within that company that has failed. The other element is on the issue of whether the issue of now the payment of the money that support the fund, can it be risk-based in terms of whether the company that is paying or the company that feel is not doing things right, can it be able to pay a more percentage than the others that are prudentially well managed? So those are the kind of the things that can be enhanced within our scheme so that we can be able to improve it. Thank you.
Thank you very much, Mr. Gitangi. Those are very good insights. Moving to Nobambo, maybe in terms of your parting thoughts, what would you think is an ideal resolution framework for your country, as well as a protection mechanism, given the unique context and the challenges that you face?
So for South Africa, the top of mind would be to remove these matters from the court processes, because as we say, I mean, until 3 years, you can imagine. So that is the one aspect, so which is we are working towards to just move those things outside of the court processes so that we have a better handle on it as a regulator. And then the second part for us is the issue around, even when you appoint a statutory manager or a curator, then you still need to pay those people. And so you can imagine the institution is already in financial distress. You appoint a statutory manager and or curator, and those costs are still attributable to the institution. So for us, it becomes a double whammy. So perhaps a deposit, a guarantee scheme or some form of funding could assist in terms of just covering those costs. I mean, part of the conversation we have is like, even the administrative penalties that we impose on institutions, maybe those can be set aside to assist in those cases of a failure or likely to failure. So that is where we are in our conversation. Thank you.
Very interesting insights, and I believe a number of jurisdictions would be willing to follow or listen to what South Africa is doing. Dr. Gondwe, maybe you can tell us what are your parting thoughts in terms of what you'd like to see as an ideal resolution framework in Malawi, as well as a protection mechanism in Malawi.
Yeah, thank you, Moses. I think for me is to agree with my colleagues, generally speaking, in terms of I don't have different thoughts, but just to add on that probably is something that that gives the best outcomes to the protecting of policyholders. I think I'm intrigued with the timelines within which the protection fund is able to start doing the payout. If that time frame is shortened, the better for our policyholders. But also from a resolution agency perspective, probably a scheme or a resolution option that is probably least cost to the resolution authority. If you are able to balance, because in these things there will always be 2 or 3 options on the table, and you need to make these judgments. So if you are able to balance up a scheme or an option that you are able to quickly pay out, but at the same time, as a resolution authority, it gives you the least cost, then that probably I would envisage that kind of scheme. And then finally, I think we normally don't talk about these things, but I think a scheme that is designed in a way that kind of mitigates or minimizes the potential systemic impact of the insurer's failure. I know these protection funds are not meant to cover systemic risk, but I think if we are designing it in a manner that mitigates or minimizes that, to me that would be an ideal way, an ideal kind of resolution authority or framework. Thank you, Moses.
Thank you very much, Dr. Gondwe. Mr. Asel, we can hear your parting thoughts on what you'd like to see. Of course, you told us about the framework that you're developing, but what else would you want to see, hopefully in future, in Rwanda?
I think it's maybe earlier to say that I will maybe start again saying mentioning items that will be ideal for an ideal maybe resolution framework. One is that maybe not that our resolution framework, which is backed by regulation of exit and insurance resolution, was just revised in 2023. It is still new, which is missing key components being PCF, which is actually about to be established. So our priority is first to push have it established, and then from that maybe the experience, then we can see now how to maybe improve and add other additional component as to make it enhanced.
Thank you very much, Asel. Thank you also, distinguished panelists. I think we will have a Q&A session. I know a number of you have been noting down questions for the panelists, so we'll have a few minutes for any questions that you may have to understand maybe what a specific jurisdiction is doing or what you'd want to borrow. Maybe we can have that session at this juncture. So I'd like to invite any questions for the panelists before we appreciate them for their input and their feedback.
All right, we'll look for the questions. I have 1, 2, 3. I think we'll take the 3 because of the limitation of time. Then panelists, once it is presented to you, just note it down and then you'll respond. Okay.
Thank you, panelists. I wanted to ask Dr. The gentleman from Malawi. You said there's no legal framework or there's no proposition in terms of compensating the policyholders or any amount that whether I got you right. So what is the resort? How do policyholders resort to if the company goes under, and how do you compensate now that you've said there's no mention or there's a lacuna in the law? Thank you.
Right, noted that one. Good. Second question.
Thank you, panelists and moderator. My name is James Njogu from PCF. My question is to Mr. Rocky from TIRA Majirani, Tanzania Insurance Regulatory Authority. You mentioned that some of the intervention measures you have include a company stopping underwriting some classes of insurance business in trying to resolve a troubled insurance company. How successful has this intervention measures been? And if you could slightly elaborate on how your insurance ombudsman operates. Is it housed within the regulator or it's a different mechanism all along? Thank you.
Final question.
Good afternoon, everyone, and the panelists. I'm David from ICA Lion Group, and probably my question will be directed to the Kenyan space. It is wonderful that we have accumulated fund of around 25 billion, and since the probabilities of insurance companies failing is getting lower and lower, would it be possible that you invest this money wisely and share it back with the insurance companies, noting that in our space, the policy holders and the insurance companies contribute? I had other two, but for time I can leave that.
Interesting. Oh my goodness. My time is really limited, but I can still see questions popping up. Any other with a question so that I now plan? 1, 2. We're good? Okay. To you. Name and then we proceed.
My name is Kitai Benedictus. I saw it fit to ask this question because I see most of you are regulators. And in your various jurisdictions, there's a concept known as regulatory failure. What role does it play in terms of making these insurance companies go down?
And as I sit here, I'm thinking instead of paying the 250,000 for claims, is it not better to rescue the company so that even if you are able to sell it or it can continue operating, since you are not even compensating the policyholders the full amount?
Thank you. Now back to you.
All right, so thank you very much. So the question was, what is it in for Malawi if the institution fails? So I think the simple answer, as I've mentioned in my comments, is that there's nothing. All right, there's nothing on the table. nothing on the table. So what happens, even from the previous scenario that we had, the only remedy now, because we don't have the policyholders compensation, I mentioned that in terms of rankings, they rank much, much earlier. They are putting priority. And they need haircut and they are given something because we don't have the policyholders compensation fund. The only way we have done it now is the Deposit Insurance Corporation provides that the board of that institution can bring in insurance members. As only if and when they make that determination, then we'll be able to come and comfortably say, no, we have something for our policy members. But as you're aware, you've got better experience than us, for you to do these risk assessments and make that decision to say, oh, I think we are ready now, we can take this risk and protect policyholders. They need to do a very good homework in terms of what risk is already in the insurance sector so that they don't deplete the fund from the word go. If you've got a lot of sick babies in the market and then you make that determination that you want to bring them and get policyholders get covered from day one, then you also risk creating a lot of pressure on the fund from day one. So they will have to make that judgment. The law for the deposit insurance has allowed insurance companies to be members and policyholders to be protected, but it is not yet operationalized. So at the moment, we have to rely on the liquidation process. And that probably, if you can allow me to tackle for the other question, which was general about regulatory, I think there was a point of regulatory failure. And I think you can see it talks to this. So in the context of Malawi, you can imagine the headache that we have as supervisory authorities in making that judgment of calling on the shots and moving in to close or wind down a failing institution. You are likely to exercise forbearance because you know that the moment you close this, there is no protection fund. So that is the regulatory failure, that the risk that we carry now, because you are likely to exercise a lot of forbearance on the understanding that probably certain things will be turning around in the course of the conversation. Probably certain things may turn around. The reason why you are dragging basically is you are failing to answer that question. That if I close this institution, which is a failure baby, then the policyholders are likely going to fail, which is not a healthy scenario. But thank you very much for that.
Thank you. I would also like to answer the question that was directed to me. First of all, on the stopping some classes of insurance or forbidding insurance company to issue a certain product, that also depends on the issues which have been on monitoring processes. You might find out that the insurance company is starting to fail only because of one product. So we do analysis and we recommend to the company, and if we see that there's a certain product or a certain class which is bringing more losses to the insurance company, then we may direct it to stop underwriting that, or even minimize the scope of their license, so that they will stick to a certain product or classes which may help the company to revive until it can be able to underwrite those bigger risks or recapitalize the company. It has been effective. Some of the companies were going under and they were having insolvency problems, but some of those measures have helped the companies to come back, and they are doing very good right now. So that is one. And another one was on the part of Tanzania Insurance Ombudsman. Of course, it is under TIRA, but it's independent because those are alternate dispute resolution mechanisms to ensure that policyholders are very well protected. So even if insurance company is determined to pay a certain amount to claimant, instead of if the claimant is not satisfied, instead of going to court processes, and we know the court processes are very long, it can register a dispute to insurance ombudsman, and they intervene. it's been very effective for us. A number of cases have been, the policyholder has been paid on time because of this having Tanzania Insurance Ombudsman. And also the cost, it is very cost effective. So that I would like to explain that.
Thank you very much. I think we ran out of time, but I can quickly respond to the question that was asked in terms of the fund size as it is. I think the data that we looked at in the morning presentation indicated that the frequency of failures are actually increasing. So we do anticipate failures will occur, and therefore issues of redistributing the funds that are within the fund may not really be beneficial to policyholders and claimants who may actually suffer going forward. Then, in terms of how is it better to intervene early? Of course, I think there was also a mention to that by the presentation from Ezekiel Masharia that, of course, the cost of failure can be reduced if you intervene early. So I think all of those are issues that all of us are grappling with, and of course, we appreciate the panelists. I'll allow Mr. Gitangi to just give one parting shot, and then we will appreciate all the panelists. Go ahead, Mr. Gitangi.
Okay, thank you, Moses. It's just to add to what you have said about the issue of the FAD. I think the FAD might sound to be big, but what was presented to us this morning, if we can be able to expand the structure of compensation, the money might even not be enough. Because we need to cover the issue of claims that have not been reported, if they can be able to be well documented even after that. So I think it is an element of reaching and protecting that policyholder who he had reported the claim, but it was not even well documented, so that we can be able to expand the structure of compensation. Thank you.
Thank you very much, Mr. Gitangi. I think we will allow the panel to step down as we appreciate them. We appreciate your insights. I think all of us have learned something, and in terms of how we will apply it in our various jurisdictions, I'm sure we will see a way into how we can incorporate it within the legal framework. So thank you very much, Madam Nobambo, Dr. Gondwe, Mr. Assel, Mr. Alex Rocky, and Mr. Gitangi for being part of this panel. Thank you very much.
Right, panelists, please welcome back to the podium for a photo. We want to keep these memories, including the moderator, of course. Please welcome to have this photo, and then we shall be able to proceed. Meanwhile, we can have the podium back on, and yes, please welcome back for the photo. We don't want to forget about it. And for the African girl, they were told that they need to be very demure, very mindful, very cutesy, very amazing people, and that's how we grew up. But this space now has allowed us to all come out in our levels. The men are empowered enough, the ladies are getting super empowered, and I hope the men can still keep up in the journey by being able to marry these super empowered women and thrive in families, I believe. Now, this is now going to be agenda conversation. I'm going to give you any conversation involving the male. So if I say any word that is male or a pronoun that is male, you just clap once. Let's try. Man, he, boy. Now, if I say anything or any word that is female, you clap twice in quick succession. So let's try she, girl, her. So anything male you're clapping once. Anything female you're doing quick succession 2 claps. Okay, we try. Boy, girl. Good, that's a good audience. Now here goes my story. In case you hear any reference to the feminine, quick double clap. Any male, 1 clap. As we have our next presenter coming over. So here we go. One man told his wife. So his was 1 and then wife. Okay, we try again. One man told his wife that he needed her to bring him some money. I see what you did there. So money is male. Very well. We're going to have our next presenter, Mr. Alistair Campbell. Of course, he's the President and CEO of Property and Casualty Insurance Compensation Corporation that is in Canada. He was with us in the morning and we have the privilege of listening to him once again. Please put a round of applause as we welcome him to stage for this presentation. Please welcome. Much welcome.
Oh no, it's that Canadian guy again. Thank you for your patience. If you're going to listen to the same voice for a second time. The topic is aligned but different. So I hope it's going to be enough to be worthwhile. And I'm wearing a different hat. So I am wearing the hat as co-chair of the Policy and Profile Working Group of the International Forum of Insurance Guarantee Schemes. I am a former chair of IFIGS. Kenya is a founding member of IFIGS. And I am co-chair now with Kenya of the committee and working group that I just described. So just a couple of things to tell you about the agenda. I'm going to talk to you about IFIGS. I'm going to talk to you about a few things that have happened in the last decade, just some case studies to help us understand the idea that failure is still around and it has complexities to it. Some general comments about insurance guarantee schemes and then a quick summary of the IFIGS framework guidance. So, first of all, this is our international forum. It now is comprised of 29 separate insurance guarantee mechanisms from 21 jurisdictions. And it also has some associate members who are in the process of establishing a guarantee mechanism but have not yet got it legally constituted. I think I've gathered from the conversation today that we should be trying to recruit Uganda and Rwanda as associate members at this stage. It's free. So I hope you find that price attractive. You would be welcome to join. I think we have our upcoming annual meeting in Kazakhstan in August. Maybe you should join us there. Here's the membership. It's great, but it's not nearly what we'd like it to be. There's 2 reasons for that. There are some insurance guarantee mechanisms that haven't joined yet, but mostly the world doesn't have enough of us. And so we need to spread the message. Africa, there's 1 member today. The Middle East, we just added Turkey in the last 3 months. And there's only one in South America, Ecuador. There's all of these spaces that still are untapped. Our organizational structure, because it's a volunteer group, is simple. We have 3 members of our executive committee at any one time: the chair, incoming chair, and the exiting chair. So that's the first and second vice chairs. So at the moment, Kazakhstan is our chair. Korea is the incoming chair for next year. And so our annual meeting in 2026 will be in Seoul. Well, maybe they'll invite us somewhere else in Korea, but it will be hosted, as always, by the chair. And the outgoing chair is Spain. We were in Madrid for the conference last year. We have these working groups. Everything is a volunteer structure, and we do our best to have some coherent strategic planning, some coherent information sharing, and focus on policy and profile. What are we working on now? We're working on this catalog of insurer failure. We're thinking quite a lot about contingency planning and desktop simulation exercises and crisis management working groups. And are there ways that we could spread best practice around those kinds of work that all of us are doing in our own jurisdictions? We're doing a lot of work on the role of an IGS in resolution. Jurisdictions all over the world are working to enhance their resolution frameworks, establishing national resolution authorities in the insurance space. There's key attributes defined by the Financial Stability Board. These are being rolled down through the International Association of Insurance Supervisors. But obviously, the moment you get to resolution, you're starting to talk about an area that is pretty core to the functions of an insurance guarantee scheme. So where do we fit in, and how do we add value in the most effective way? And we've been spending time thinking about climate risk and whether that is increasing solvency risk, and we're doing that in partnership with the Toronto Centre that I suspect many of you are familiar with. There's a half-day workshop that we built with them that they have been hosting regular sessions on around a specific case of an insurance company failure that was pure climate driven, and I'm going to mention it in more detail in a moment. So just 3 quick case studies to amplify the complexities. The first, a New Zealand domiciled company, but it did almost all its business outside New Zealand. It was licensed in multiple jurisdictions in Asia and Europe. All of those jurisdictions were assuming that the New Zealand supervisor was totally on top of this thing. But the New Zealand supervisor was paying almost no attention because it wrote almost no business in New Zealand. It created an incredibly complex corporate governance malfeasance model around passing insurance and reinsurance around amongst themselves to pretend they had more capital than they did. And then they failed. It triggered defaults all through Europe and Asia. Some had policyholder protection, some did not. The lawsuits will last another century. It's an example of what happens when cross-border is not managed effectively and where the role of a host or a home supervisor is not clear. And so IAIS and IOPA have been spending a lot of time on this file because who should be the supervisor accountable is quite an important point to clarify in the case of cross-border groups. And I mentioned earlier that Guyana in Africa had a failure that had nothing to do with them. It was a failure of the Home Office in the Caribbean that caused the failure of their one insurer in our database. Second case, this is the world of Solvency II. What could go wrong in Europe? Here's a pension, life insurance company offering a type of pension program. The accounting standards changed. They were technically insolvent. They were supposed to put new capital in. New investors were found to put that capital in. That capital failed to materialize. It took quite a while for the failure to happen. You could see it coming. But the Dutch had been very firm that they did not believe that insurance guarantee schemes were necessary. They have now created one for life insurance after this failure. In this failure, the policyholders were forced to take haircuts. I don't know about you, but most people have a plan for their pension, and a haircut on a pension is an awful thing to imagine. A promise fundamentally broken, and broken with no policyholder protection. So a very vivid example of, I think, both the importance of effective supervision, but also why policyholder protection matters. This is our scary climate change scenario. So this is a small regional insurer, 128-year-old company in a portion of California that's increasingly prone to wildfire. There is a wildfire known as the Camp Fire. It happened in 72 hours, and it wiped the entire town of Paradise, California, painfully named, from the map. The entire town burned. Most of it not evacuated. 86 people died. 17 billion in insured losses. 18,800 buildings. Merced had a very large market share in Paradise, California. It was where their head office was located. 80% of their policies were total losses. They didn't remotely have the capital or the reinsurance for such a scenario. In fact, no property casualty company has enough capital and reinsurance to handle total losses on 80% of their portfolio. Down they went in a week. So normally we always say failure happens in slow motion. You could see the chronic underwriting losses. You could see the problem coming. This company went from a solvent, 128-year-old track record of underwriting profit to insolvent in a week. So the idea that climate risk is probably increasing solvency risk because we are having events that are happening that are outside previously modeled events, or are events that are very hard to model. I mean, there are people now selling wildfire models, but they're based on still very preliminary science. And so I think are particularly nerve-wracking. I have one more case study that I don't have a slide for, but it's of interest, and our research team are still working on the write-up. It's called Eurovita. It's an Italian life insurance company. Now, one of the critical arguments we make in insurance is that you can see these things coming, and we're not like banking. There's no runs on insurance companies. Not like a bank where confidence can collapse in days and liquidity freezes up and everybody lines up to take their money out. It's all over. That doesn't happen in insurance. It happened to Eurovita, a life insurance company in Italy. And it happened quite extraordinarily. They had a big portfolio of Italian government bonds. In 2021, interest rates moved. They had a big, on paper, loss. No problem. They're holding the assets to maturity. But an assessment, like the model used in Canada. And then there are these questions about moral hazard. So just quickly, when I go to IAS or IOPA, this is the #1 argument. If you have a guarantee scheme, customers will recklessly choose the cheapest price from the dodgiest fly-by-night insurer because they don't care. There's protection. Honestly, that one drives me crazy. Put up your hands if you can confidently read an IFRS 17 financial statement of an insurance company today. I've got one hand, two. I want to learn from you. I have been going to class for 3 years. I have been going to all the training programs. I read statements on weekends. I do not believe that I could spot looming insolvency of the insurer that I'm buying my car insurance from. Could the normal retail consumer be expected? The new financial statements are incomprehensible even to financial professionals. It is not fair to ask retail consumers to somehow divine the potential solvency risk that they're assuming when they choose to buy their home or car or small business insurance from one insurer. A policyholder protection scheme just makes more sense. The other argument is that insurance executives run their companies differently if there's a scheme. We all know insurance executives. I used to be one. They're chronic optimists. Somehow they will make it work. It's always worked before. Insurance executives do not change their management behavior because there's an insurance guarantee scheme in their jurisdiction or not. It has no impact on their behavior. The last thing they're really thinking about is the policyholder. The bad guys are mostly just thinking about themselves. And so the normal consumer should be protected. So that's our view at IFIGS. Despite improved supervision, failures will still occur. Despite higher capital requirements, failures will still occur. Some form of insurance guarantee mechanism is a logical component of a comprehensive framework, and it's better to have it than not to have it. And if it's structured right, the supervisor gets a whole bunch of added benefits because they have access to expertise. Guaranteed best system. There is no one-size-fits-all. Our membership has a very diverse range of structures and totally different designs and governance models. We have public sector, we have private sector, we have blended public and private sector, we have wholly integrated banking and insurance in one, we have other jurisdictions that segregate car insurance, construction insurance, life insurance, and has little niches with different mechanisms designed for specific lines of business. We have ex-ante, we have ex-post models, we have unlimited full policy limit paid, and we have defined limits like the Kenyan 250,000 shillings. And we have organizations that focus on compensation, and we have others that really specialize in continuation models like the life insurance long-term contract solutions that we were discussing this morning. And we have some that are paybox, and we have some that are paybox plus, and we have some that are paybox plus plus plus, and we have some that are full resolution authorities. All of those members of IFIGS are sitting at the same table. The key point we want to make, any of these mechanisms is better than no mechanism. And why are there so many different structures? Well, our countries are all different. We have different industry structures, some with lots of composite insurers, some with none. We have very different competitive environments. Some jurisdictions with a handful of giant companies, other jurisdictions with many, many small companies. We have jurisdictions that have mostly foreign, and we have other jurisdictions that have almost no foreign. We have jurisdictions that have different attitudes towards risk and failure. I would highlight America, again, as an example, where they have failures all the time. It is normal. It's like breathing for them. They just assume that there will be more innovation and more competitive dynamics and a better outcome for consumers overall if they allow more failure. But they all have insurance guarantee schemes, every state, for P&C, and a separate one in every state for life. And obviously, different jurisdictions have different regard for moral hazard. It's your problem if your company failed versus it's a society problem. So what advice can we offer? Conscious of my 30-minute assigned time here and everybody's attention span. What we did at IFIGS was try and create a framework guidance, a set of principles, so that jurisdictions that are looking at creating some form of mechanism would have some framework for thinking. It's not overly prescriptive because we have so many different models, but there were a set of principles that we found we had in common. You should define what your objectives are, and then you should build the IGS to achieve those objectives. Maybe not that profound, but you start with first principles. You should then define the mandate and powers of that IGS to align with those objectives. And then you need supervisory. All of these things are a long way up the learning curve before you weigh its designed. Then you need a governance from the supervisor. It should be well governed. You have to have a defined related framework. You're just part of it. So you have a watch list, but you should be discussing that watch list with the supervisor. Supervisor has a watch list. They should be discussing it with the IGS. The moment there's a sign that there's a serious problem, create a working group. Start planning for worst case scenario so that you don't have crisis of confidence. You don't have reputational issues for the market. You minimize the reputational issues for the regulator, and you absolutely minimize the possible backlash on politicians who in the end are accountable for the system. And we'll really be hoping that you do your jobs. All of those, I think, are totally reasonable. And then when you get to cross-border, that's even more important. If you've got insurers in your marketplace that are active cross-border, you've got to be connecting with the other guarantee schemes, and you've got to be connecting and ensuring the regulators are connecting. When we meet at our AGM, I always ask our Norwegian and our Danish counterparts if they're finished suing each other. The answer is they're not. That's going to go on for a long time still. There's a Danish company that failed. It was selling policies in Norway. The Danish Parliament passed a law, said we will only protect the Danish policyholders. The Norwegians, easy. 5 minutes, easy. Cross-border issues should be planned out and thought through in advance. What's the role of the IGS in contingency planning and crisis management? Should be at the table. This is often challenging because the regulators do have an obligation for confidentiality and often have legislative rules about who they can discuss things with. That's why you need to get the legislation right so that the compensation scheme or the continuation model, they can be part of the working group early in the process. But that way you can have system-wide solutions planned in advance. And if there are resolution frameworks, the IGS should be part of that. Membership in an IGS should be compulsory for all authorized insurers carrying on protected lines of business, unless they're government-owned. You can just see how diverse our membership is. We have government-owned insurers in a few jurisdictions, including Canada. And coverage should be clearly defined so that policyholders can at least understand whether or not there is protection available and what's the scope of that coverage. Sources and uses of funds need to be clear in advance, whether you're going to have an ex-post model or whether you're going to have an ex-ante model. And if you need more liquidity, what are your solutions for finding it? I showed you our Canadian set. We had 60 million in the bank and then a line of credit. I did not mention the fact we've recently secured credit ratings from Moody's and Fitch and could now borrow on behalf of the industry and issue bonds. So that's just happened in the last few weeks, but a project we've been working on for a couple of years. Just building out sources of funds for crisis scenarios. Public awareness, this is one that is really not consistent across our membership. There are many that feel very strongly that communicating the existence of the scheme is of benefit. That was the consensus view, and it's in our framework. But we do have a couple of members where they're quite militant that the opposite is the case because of this moral hazard risk. Legal protection, this is a bit selfish, but any employee of an IGS needs to be legally protected from lawsuits. They're doing their job. They're doing it, but they're not a civil servant. They need to be engaged and protected against the lawsuits that can come from resolution scenarios where shareholders are unhappy. Early detection and timely intervention is obvious, but so many jurisdictions we only get told when it's too late and there's no time to plan. And then obviously our duty is to meet the obligations as defined. And in order to ensure that's clear, it's got to be clear when we're engaged and when we're not. There should be a clear trigger. okay, now it's the IGS's job. And that can't be blurry. We have some painful cases in our network's history where that was too fuzzy and didn't work well. And finally, recoveries. If at the end of the process there are assets in the estate, the IGS should be in a position to secure their share of the recoveries consistent with the creditor hierarchy. I don't know if you do this here in Kenya, but in Canada, when we pay a policyholder's claim, they sign their rights to us and we get in line. And if there's money at the end, we pay it back to the industry. So that framework guidance is available on our website. It's translated so far in English, French, Spanish, and Korean. So pick one that works best for you, and I encourage you to dig in. If you do have questions, we'd be thrilled to discuss one-on-one to help any jurisdiction that's thinking about how to do this right. And we share what we've learned. And for those of you who are close to building a new mechanism, I encourage you to connect with iFigs and join us. Thank you.
Thank you. Thank you very much. All right, ladies and gentlemen, another big round of applause for this wonderful presentation. That was quite elaborate and we sincerely appreciate. Now, to the final presentation. The gentleman who is about to come for the presentation, told he was actually supposed to be catching a flight at this time to go and attend to another session, but he was gracious enough to change the timings so that he could share this moment with us. That is how much he cares and loves this team, and it will be wonderful to share the insights with us. Now, I want to introduce before you this gentleman who several years ago, while I still had a lean body with some cubes, he just smiled and told me, your future is bright, just keep working on this skill. I believe I am doing you proud so far, right? Thank you. You had no option of saying no. All right, this is Elias. Elias Omondi has over 15 years of experience in developing policies and regulations in the financial sector. He leads the development and implementation of programs that work to improve the enabling environment for risk markets in Africa, to drive systematic change in the market for insurance and other risk management instruments at FSD Africa. I'm confident you'll tell us what is FSD in full, right? Good. Previously, he worked as an actuary at the Insurance Regulatory Authority, that is where we met, in Kenya, where he was instrumental in the development and implementation of risk-based regulations and automation of supervisory process and tools in the insurance sector. He also supported the market innovation, designing and testing innovative mechanisms of risk management, and through the formulation of regulatory sandbox that is called Bima Box, and InsurTech accelerator platform, Bima Lab. Elias worked on various international technical assistance projects for the World Bank. Wow. So they know your name. They can actually give you a loan directly without mentioning Kenya. Good. He has worked with World Bank, IMF, and GIZ, assisting over 15 regulatory bodies in the insurance, pensions, and capital market sector in Africa, Asia, and the Caribbean to strengthen the regulatory and supervisory frameworks. Elias holds a Master of Science in Actuarial Management from the Business School, City University, that is in United Kingdom, and a Bachelor of Science in Actuarial Science with IT from Maseno University. He is an executive of sustainable finance from Oxford University, certified expert in ESG and impact investing from the Frankfurt School of Insurance and Management, or School of Finance and Management, Germany, and Associate Actuary of the Actuarial Society of Kenya, that is TASC. and the Insurance Institute and Faculty of Actuaries, United Kingdom. We present before you a gentleman who has the elaborate experience to deliver the very best of knowledge in this field in the most articulate terms and ensure that your final session of the day is packed with the excellence you deserve. Please put a round of applause as we present before you Bwana Elias Omondi.
Right, sorry, it's usually quite hard to be the last presenter, given that most people want to catch the next taxi or basically be in your hotel room, really trying to, kind of reduce all the efforts that you've managed to put together today. Right, so I'll be talking about the future really. We've gotten a number of very exciting, I would say, discussions through the day, really showing why policyholder compensation is important. And with the changing world, the level of, I would say, failure will increase. And that's what I'm going to talk about. What does the future hold when we talk about climate, environment, social governance issues? I was lucky to have worked with the Institute and Faculty of Actuaries in the UK, looking at how then we can really integrate sustainability issues when it comes to solvency and trying to really advocate for the future of ESG. So my discussion will be how important is it to integrate ESG, and how then do we create a sustainable future given that the world is becoming more unpredictable, and that in a way will even make the work of policyholder compensation to be much, much more difficult given the uncertainties that we are currently experiencing. I'll try as much as possible to really make this particular presentation not be very long, but all of us understand where we are coming from. The world is currently facing a number of challenges arising from the global warming. All of us know that there is need for the financial sector to really think critically on how then they can be part and parcel of building this future. Now, this started some time back, and we are not basically saying that ESG, environmental social governance, started just yesterday. It is a discussion that has been there for quite a while. And importantly, we just need to really look at how then it can be integrated within our financial systems. Now, leveraging on where we are coming from, we all understand that if today you checked, the temperatures have been rising, and all of us, in one or the other, you realize that you need to have a cooling system within your houses. We also know that nowadays, when it comes to issues around flooding, it has become more rampant. A couple of months ago, if you are in this city of Nairobi, you realize that different parts of this city can flood, and a couple of insurance companies had to pay a little bit out of claims. The second component is issues around community and relations. Really social elements will be very critical in terms of how then this particular sector, the insurance sector, will address these issues. Importantly, are issues around emphasis on governance, given that we all are aware that ethical management and transparency of issues around corporate governance needs to be clearly adhered to. And if you look at where the insurance industry is at, particularly the financial sector, there's a lot that has already been done when it comes to governance. So if you went across the global report around the World Forum, this particular report highlighted some of the major issues when it comes to what are some of the risks that we are currently experiencing. One of the most important elements, if you look at the top risks in the next 10 years, then climate-related risks will be on the rise, and that is a move from what we saw 2 years ago, whereby when it came to issues around climate, that was not a very major risk, but currently we see the top 4 risks are hugely related to issues around climate and environment. So it's really then critical for the insurance sector and also the policyholders' compensation funds to start critically thinking about what really needs to be done when it comes to these key risks that we are currently seeing kind of coming up in a big way. This is something that should be really threatening. If you looked at how the global temperatures, monthly temperatures have been increasing, we all really want to have these particular temperatures reducing by 1.5 degrees. But the world is really running out of the options. Now, if you look at the rise of the global temperature and you kind of put a trend, you'll see that even though we are talking about really addressing the global temperature change, that is not what is in the reality. The temperature has kind of been increasing, and one of the key things that was mentioned by Al Gore, I remember he said that we are on the pathway to hell if the world did not take time to relook at this thing critically. I'll be able to also go further and look at how then this really impacts our financial markets within the continent. Some of really interesting facts here. If you look at where we are as a continent, Africa is hugely blessed with the natural capital, and that's an important aspect. Over 62% of African GDP is driven by the natural capital. That basically means the woodlands, the grasslands, and even just your backyard. I know some of us, once you kind of made it in life, the first thing that you don't want to see is anything green and soil. So you kind of bring very nice pavements. And the next few days that you realize that your backyard is flooding, you don't know why, because you managed to change your ecosystem. So 65% is driven by our natural capital. Importantly, 30% of minerals around the world can come from Africa. So that basically means that the financial sector really needs to start looking at this importantly. Out of what we call the lungs of Africa, the Congo rainforest is the lungs of Africa, can really absorb all the carbon that is released in Africa and also part of the world. Importantly, also we depend highly on nature. The impact of climate change is highly disproportionate. We are hugely impacted by the effects of climate change, not arising in this particular continent, but is basically hugely contributed by the global north. And we only, in a way, contribute less than, I think, 3% of all the global emissions. And over that, then we estimate around $195 billion will be lost if we don't really do anything about this change. And within that African GDP, we can, in fact, we say that some of the countries will lose up to around 10% of GDP by 2050 if we don't really manage these particular issues. Another critical component around energy. Access to energy in Africa is still a big issue. Around 600 million people do not have access to electricity, and that's why maybe, I don't know, we are called a dark continent, maybe because we need to get access to electricity. But what we see around this is that we have a very big opportunity to address such incidences. The standard of living, so around 40% of Africans live below around below $2, which is quite alarming. Significantly, what we see is that Africa is hugely blessed with the renewable energy capacity. 40% of the global reserves from things like cobalt, manganese and platinum all are in Africa. 60% of solar resources globally will be affected in Africa, and yet we only see only 1% of that fully installed in Africa. And geothermal, great within the continent. Now, if you look at this particular diagram, when we talk about SDGs, and this is where there will be a clear investment opportunity for us, the emerging markets need around $3 trillion of investments, and these would be really broken down in different sectors. Energy takes a big component around it. The nature, whereby we talk about agri-food systems, agriculture will be a key element within the continent. Then issues around biodiversity, really looking at our ecosystems, and also importantly, issues around water. In fact, it is estimated that Africa will really support the continent, the world, in terms of the fresh water, given that Africa has a lot of fresh water into the future. So a lot of issues that really needs to be addressed to really close this gap that we see around issues to address these critical elements of SDGs. Now, if you look at and this is really, really important, the Financial Development Index. In the 1990s, you can check how the world was. And ideally, Africa has not really changed much. To 2021, so many countries have changed in terms of their financial index. That means that they're doing better when it comes to the financial sector and how the public receive their financial services. Now, if you look at Africa, there's only one country that has tried to change a bit, and that's a bit of Nigeria and South Africa, but all the other countries, the color is the same. What's the color of Kenya? It's still what people are experiencing in the 1990s is what we are still experiencing now. The only thing is that now we have Gen Z around Kenya. So the key thing is that this is really, really critical, that the financial service has to be entrenched within the country, and creating confidence. Organizations such as Public Policyholder Compensation Fund can, in one or the other, increase the confidence that people might have within the insurance sector. If claims, if companies fail and people get payment, then we might start seeing a little bit of change in those particular countries. So where is the opportunity, and how then do we build this? The insurance capital. And when we talk about the insurance capital, the insurance investments really has a potential to grow by around 75% by 2040. Now, the total insurance capital in Africa is around $400 billion. And that can be pushed to around 600 billion by 2030 and 700 billion by 2040. And that basically means that there is need for us to increase the confidence that we have within the financial sector. Now, if you look at how then that particular growth, in terms of the growth, we are looking at around 6% growth in the assets under management within the insurance sector, and that has to be enabled by creating confidence within the insurance sector. So that means that we really need to look at how then integration of ESG becomes within financial play. When you look at what this particular element will bring, issues around sustainable development will be key, not only investing in what we call already existing financial instruments. There is need to really look at the new financial instruments that are going to come that will support the growth of the African continent. So we talk about a lot of issues around natural capital. How then do we invest our money in these particular assets? There's also need for risk management, which really will help us to navigate the challenges that the continent is facing. There is need to attract new investments. Climate change will be always part of the discussion. Capacity building and issues around social equity is quite key. We all are aware of what lack of cohesion and inclusion can cause in any country. So when you look at this, then there is what we call an insider view and an external view. Now, from an internal view perspective, there is need for companies to think about how they affect the planet, right? So how then do you develop your systems to make sure that you don't impact the planet? Now, if you looked at what happened during the COVID period, in fact, there are so many natural ecosystems that were replenished because everyone was running to basically hide in their houses. So the new species of animals came up and the world managed to breathe because the people that suffocate the world were basically hiding inside their homes. Now, that basically means that we really need to take care of the planet that we are living in. The second thing is that how then does this planet impact your organization? So there are two critical elements, and this is something that really needs to be thought through, even from the policyholders' compensation side and the financial sector, is how then do we integrate climate-related considerations within our systems. Are you able to do your stress tests and be able to tell how many companies are going to fail, given that these are real risks that will even increase the frequency of failure? And do the companies even understand what exposure they have within their systems? I won't talk about much. It is critical, it is important for everyone to integrate ESG, not only from where the investors are looking at. Currently, we see a lot of investors focusing on sustainable companies. We've also seen ESG presenting a very big business opportunity, given that there are already newer products that will be developed for the world. We've also seen the global regulators advocating for ESG integration, and importantly is issues around disclosures and regulations. So ESG adoption is no longer a regulatory issue, is a strategic issue that really needs to be thought through from a financial sector perspective. Now, these are some of quite interesting stats. Capital providers, those people that linked performance of ESG to their business, we could see that up to 5% of those particular companies have performed what other industries or what other related companies were doing. Over 1,800 laws have been put together, so that basically tells you that regulation is quite big. Customers nowadays focus on ESG, so 76% of customers would refuse to purchase a product if it's not ESG linked. And companies that did that had a 16% productivity, and we need to capture savings whereby we reduce our emissions within our supply chains. So when you talk about ESG is just a measure of sustainability because the world is becoming more sustainable. And in that particular case, then I know you've heard about natural laws and issues around climate, whereby if you further drill down towards what climate impacts, then we have issues around net zero, whereby we reduce our global emissions. We know very much that each and every kilograms of carbon that we release has an equivalent impact on our environment, and that is what is really causing the rising temperatures across the world. Now, how then does this fit within the financial sector? And I think this might be the most critical slide that you might really need to see how then this comes together. So if you look at how this will impact your financial systems. It will start from what are some of the risks that we are going to face as a financial sector. And this can be broken down into three main buckets. One of it is what we call physical risks, and these will be mostly weather related. So if there's a flood and there are increasing claims, that basically means that the frequency of payment of those claims will be much higher, and even their impact. So it will kind of impact your underwriting loss because it will cause a number of things within the economy. So business interruption will be something that most of the time insurance companies do insure. Issues around capital scrapping. If you have invested that premium in purchasing a building, and that building always floods, you'd think your clients will remain there. All of them will relocate to a higher ground. So again, capital scrapping comes in within that particular facet. Issues around migration and so forth. So we'll see lower commercial property values, given that some areas will be more flood prone. Issues around lower corporate profitability because of the impact of climate change. And then within the financial system, we see a lot of underwriting losses. That basically increases the risk of failure of an insurance company. And at the end, then the schemes that we are setting up will kind of be facing more stress and strain. There's another risk that we call transitional risk, and in this particular case, then there are so many policies that are going to come. How then do these policies impact our financial systems? For instance, there's need for reconstruction and reinvestments. Some of the assets that insurance companies have will be scrapped off based on climate policies. What does that mean? That's a further move towards failure. So again, the schemes will have to rethink about, even try to look at the possibilities of more companies failing because of some assets being classified as brown assets. So a lot of transition will be coming through. The last is on liability risks, and this is whereby some companies will be sued, including some of the insurance companies that have taken in some liability risk, and out of that litigation, then again, bigger exposure when it comes to climate related risk. So this kind of shows you a couple of risks that will be directly impacted. Most of the time we are aware of things such as insurance risk, market risk, credit risk, operational risk, and liquidity risk. But from the aspect of how then these physical risks impact them, you'll be able to see higher expected claims within the insurance industry, issues around fall of equity values due to the physical losses, flooding, and business interruptions, issues around credit risk. Some organizations will be downgraded. Basically means that in terms of how then we look at these particular organizations will expose more risks to insurers, operational risk, the disruption, and liquidity risks, whereby even people will not have enough money to supplement their income. So in that particular end, then some of the policyholders some of the policies will be cancelled. Again, if you look at it from the liability side, again, same impact. So the key thing is that the way you look at your financial systems now, these will be amplified by climate-related risks. So when the liabilities, in terms of how then we see it impacting the insurance risk, there's potential risk of underpricing, and that is what we've been talking about, and under-reserving. And importantly, I think in Africa there's a lot of underpricing. People compete to the free, how much cheaper you can become. So in this particular case, issues around new insurance products and covering green technologies, the impact of underpricing, that investment losses out of the low asset values will be a big issue, particularly from what we call stranded assets. There are some assets that some companies will have in their balance sheets and will not generate any value in the long run, because they will be disclassified. Losses around debt, corporate debt instruments might be forced to transition because of some of these litigations and legislations that will come. And again, issues around liquidity, societal pressure towards really pushing your investments to long-term green infrastructure items will be something that we are likely to experience. Now, when it comes to this last risk, it will only impact one risk that we are all aware of. So under liability risks, then we see an impact on insurance risk, whereby there will be a lot of more on claims being higher than what most of the companies expect. So how then do we really need to look at the integration process? It should be thought about in 6 levels. Risk assessment will be critical for the entire sector. So we have to really do a proper risk assessment, not only at an industry level, but also at a company level, and look at how that will impact the sector in the long run. Issues around incorporating these models into your business, whereby we are going to see a lot of stress testing coming in. Issues around supporting investments, particularly when we talk about sustainable investments, and looking at how what assets you have will not be exposed to what we've been discussing, climate risk assessment and adaptation. You're not only looking at doing what we call risk mitigation, but also there is need for companies to start thinking about risk prevention. So really adopting strategies to help your policyholders not to be fully exposed, because if the world becomes uninsurable, then what else? What will happen to the insurance industry? So there is that movement whereby the insurance industry will think about becoming and setting up adaptation strategies. I won't really dwell much on some of the opportunities that really needs to be looked at when it comes to the investment policies, but we are all aware that some activities will become unsustainable, so we have to start thinking about putting our monies on more sustainable themed instruments. So things such as green bonds, things such as sustainability linked bonds will be critical, but also just to look at our investment strategies in the long run to enable the business really take in the impacts of climate change within these particular spheres. This is quite interesting, whereby we looked at the African insurance asset allocation, and over 70% of all assets are basically kept by government, which really means that there is need for us to start thinking about kind of supporting the growth of alternative investments within the sector, given that we already know that even though we believe that 100% government cannot fail, but generally we understand that some countries are already not failed, but have in a way softly defaulted some of these instruments. So there is need for us to critically think about what are some other investment structures that we really need to bring into play. And I don't know also how the policyholders' compensation schemes have invested their monies, because the key thing is that you also need to start thinking about investing into the future of the sector. So really trying to support the industry to manage the impacts of climate change. I think I'll use less than that. So there is need for us to think about deploying our assets into what we call green investments. And already we see the potential of the African continent when it comes to green investments. So are we likely to see some of the monies that are being collected from the industry developing and supporting the insurance industry from paying more claims, because we are building resilience within the ecosystem that most of these companies invest in? That in the long run will support and reduce the impact of failure within the financial markets. So in terms of what we want to see is then how then do we, in essence, I talk about crowding out most of the investments in government securities. How then do we support regulatory constraints? Because also if you look at the reason why companies put their money in some of these instruments is because the regulator said so. In fact, if you invest in alternative assets, then the haircut becomes a major issue. So most of the time the investment managers do not really need to think hard. They just need to remove the investment regulation and say, as per the regulator, and that's it. So they're employed just to become a regulatory investment manager. So there's the things that we really need to kind of start pushing hard in terms of even the free assets that some of the organizations have, and even looking at the funds that some of the schemes have collected to deploy into these green investments. So where are we likely to see the future investments? So this can be broken down in a couple of industries. So we have some large sectors. So if you think about renewable energy, large infrastructure projects is something that we can think about as a sector, but also as schemes whereby renewable energy generation will be important. There are also things to do with the green industry projects. Think about, green steel, green ammonia, and really looking at batteries, given that the future will be more on batteries, and EVs will be a critical driver. So as a sector, we're likely to see ourselves moving that particular direction. We'll have also transition projects, green buildings, and EV transportation will be quite key towards EV passenger cars and EV trucks. Some of the kind of longer term projects that we are likely to see. But importantly will also be to direct to customers projects. I know all of you have been thinking about clean cooking. We've seen that in Africa there is need for us to deploy clean cooking. If we don't do that, then the next thing we'll not have our forests, because they'll be trying to cook with anything that can light, including all the trees. Cooling will be an important element, and two-wheeler, EVs, and mini grids. I know some of you have already installed some mini grids within your homes, just to make sure that you try to run away from the impact of KPLC. We just saw it when he was presenting, when everything just disappeared. So importantly, issues around energy. On the other side, because I've been looking at it from the asset side of the balance sheet, what are the opportunities on the liability side? What are we likely to see the industry doing? Is developing sustainable insurance products. In this particular case, then there's need for companies to think about repricing of some of the products, given that we are going to see newer solutions coming through. So how then do you enable your companies to start building this particular component? Underwriting standards and guidelines will have to change, given that some of these new sustainable insurance products will require a bit of change in how then you do underwriting, and in terms of how then you price them. And lastly is issues around product development. Consumers will push the products where they want them to be, and they will be more really looking at what really aligns to their preferences. So it's quite a number of dynamics that we are likely to see on the asset, on the liability side. So some of the new products that we are likely to see on the personal lines, then green property will be a key product line that we are likely to see within the insurance industry. Issues around low mileage pay as you drive, particularly on the EVs, will be a key element. Issues around more efficient transmission vehicles, again, really trying to close and reduce our emissions. Importantly, on commercial lines, then we are likely to see investments or basically taking risk out of these renewable projects, programs, insurance for the green buildings, and also issues around carbon capture. So are we likely to see an insurance company providing opportunities for carbon capture? Are we likely to see policyholders' compensation scheme investing in carbon capture for the future? So kind of thinking about things that, like, we are the first policyholders' compensation scheme to capture carbon. So they'll ask where you're taking it, but you will have an answer around that. And then lastly is issues around carbon storage. So it's not only capture, you need to know where you are going to store it. And most of the time, it's usually pumped in the rocks, and it can stay there for a couple of years before it's released back to the environment. So it's a very difficult science around it, and already in Kenya we have a company that is already capturing carbon with some very exciting technology. So insurance industry, you need to support and ensure that risk of such instruments currently being used out of carbon capture. And then they are really pumping it into the Rift Valley in some rocks down a couple of kilometers down the ground where it can stay there. Lastly is issues around specialty lines on environmental liability is something that we are likely to see, whereby, insure for pollution. Just go and tell the company that we are going to insure you to make sure that you are not going to you won't go to court because of pollution. So again, environmental liability comes in play. I know all of you have heard about carbon credits, and these are big discussion whereby even here in Kenya there is a carbon stock market that is currently being established. So what are some of the exciting carbon instruments are we likely to see? There are already 170 types of carbon credits that we can deploy our resources to, from issues around renewable energy to households and communities, whereby we talk about clean cooking and energy efficiency, to issues around chemical industry, whereby we look at carbon capture and storage, to elements such as waste disposal, which again, we really need to look at how then you manage waste and how much carbon that particular waste releases to the environment. So again, very good investment opportunity for the insurance industry. At the same time, a good industry for us to really think about how then we can support this particular ecosystem of carbon credits. Now, what's my call to action, which is again another most important, I would say, slide. If you did get anything out of this, kindly you can pick these 4 things, is that you need to understand why this is really, really important. And this is just a personal call because, it requires all of us to take care of our environment, from an individual to an industry to a company. Just how then do we make sure that there's a future for all of us? So the next thing is we have to reflect on the risks and impacts and opportunities of ESG. So we are not really just saying that this will make sure that all of us will not be there, but there are clear opportunities for the continent. Already we've talked about the natural capital, the issues around the renewable energy, presenting a very good case for all of us in terms of how then we can pick out some of these particular opportunities within the sector. Then we have to invest in the right integration mechanism. From your balance sheet, what can you do? You have an opportunity from the asset side to put your investments in the right channels. At the same time, you have also an opportunity to underwrite rightly and to make sure that some of the new emerging opportunities are sustainable insurance are reflected. And lastly is that this is a journey. So it is a journey that will be taken up by, I believe, when we talk about the greening of financial systems, it has a bigger impact within the insurance industry than any other industry, because this industry takes care of risks, and also it will have a huger impact, it will have a bigger impact when it comes to this if we don't really take care of our own industry as a sector. Already there's a lot of work that is going on within the banking sector, but you see, for the banking risk, it's only credit. Most of the time it's credit, because they fear that somebody will not be able to pay because his house will be flooded. Now, the house that the bank is only thinking that this person will fail to pay has been insured by an insurance company, and at the same time, somebody has invested their monies in putting up that particular building that needs to attract some income. So this is a journey, and it has to be taken up not only by you as a person, but also within our sector on how then we derive change for the future.
Policyholders Compensation Fund does things the African way. And the African way is that whenever a guest speaks to us, we reward them with a gift that is not equitable to the value of their speech, but with a sentimental touch of class for what you delivered. So, for that reason, I want to indicate that for our speakers today, we have prepared a gift for you. I don't want to say it is small. You know, the kind of trying to be nice, oh, it's a small gift. It's not small. We incurred very serious expenses, and the reason why we did not present them earlier is because they were still on the flight into the country. Buku, who is the director at the Policyholders Compensation Fund, this presented